Hello and welcome to day 2 of Aditya Birla Sun Life Mutual Fund presents Voyage 2022 partnered by ET Now. My name is Sumit Lakhotia. Now, as you know, our theme this year is India navigating with resilience, and we've had a power-packed day 1 and day 1 yesterday at the 9th edition of Voyage with experts and thought leaders sharing their inputs, insights and their vision for what lies ahead of us post the pandemic. And today promises to be all that and much more. We've got a stellar lineup of speakers for you today, along with some fun contests and interesting quizzes, just like yesterday. So keep tweeting the person with the most relevant tweets. Today will win the Smart Twitterati of the day. The person asking the most number of relevant questions or putting in the most relevant comments will be declared active Voyager of the day. So do remember to use the hashtag Voyage 2022. And so that you can share your learnings. We'd love to hear from you, and do remember to tag us at the rate ABSLMF. All right, without further ado, let's get into our first session. Our first speaker today is a veteran banker, a name synonymous with the Indian financial services space. Now, with one of the biggest announcements in the banking space being made in the last few days, the Indian banking sector has achieved new heights, and our speaker will share his outlook for the Indian BFSI sector. Please welcome Mr. K.V. Kamath, former chief of the New Development Bank of BRICS countries, former chairman of Infosys Limited, a veteran banker. We all know him so very well. He needs no introduction. He'll be in conversation with ET Now's managing editor Nikunj Dalmia and Aditya Birla Sun Life AMC Limited's fund manager and analyst Dhaval Gala.
Sumit, thank you for that introduction, and good afternoon, everyone, to all the attendees. It's a large Birla Mutual Fund family, so good afternoon to all of you once again. I must say Sumit has introduced Mr. Kamath only in the capacity of his experience as a banker, but I must say that I have interacted with Mr. Kamath on various forums, and he's one of the most extraordinary human beings I've interacted with. His idea about life, how to keep it simple, basics of how to run a business are things which I've learned over the year. And I must share with our audience here and with our attendees here that every time I've met him, his ability to think big and to dream big is incredible. A few years ago, when he gave us this map of the Indian banking sector and how large the economy could be, those were unbelievable numbers. But today, India's GDP is almost $3 trillion. The balance sheets of Indian banks are nearing global levels now. This is something Mr. Kamath always talked about, and today that is the reality. Dhaval Gala also joins us, and the problem is that while he can be a great anchor along with me, I'm not sure if I can be a great fund manager if given that job. So it's going to be a challenge for me to take his job, but I'm sure it will not be a challenge for him to ask questions along with me. So Dhaval, welcome to the show, and it's a pleasure to have you as my co-anchor.
Thank you for Mr. K.V. Kamath's time as well, and me to host you along with you. Good afternoon, Mr. Kamath, and good afternoon.
Good afternoon, Nikunj.
Mr. Kamath, for the banking sector, the worst is behind us. That is something which I think we can establish with a lot of authority looking at the NPA cycle. But are we at that decisive turn for the banking sector where the next 3 years would be radically and dramatically different from the last 3 years? Or is the Indian banking sector at the cusp of a very strong cycle?
Indeed, yes. And it's an unequivocal yes. There are 2 or 3 reasons. The primary reason is what is the health of the balance sheet of the Indian banking system. I think it is more pristine than it has ever been through my long career in banking. Because the cleanup of the last 3-4 years has flushed what was not needed on the balance sheet, and injection of fresh equity has made you all that more healthy. So I think that's the first lever. The second lever a banking system requires is the economy. Is it facing headwinds? Is it facing clouds? I think if it were to face clouds, it was last 2 years. But the way we have come out of it, the way the country has managed the system, and thanks goes to the leadership in terms of the Ministry of Finance and the Reserve Bank of India, to keeping the system resilient, I think has again augured well for the banking system. The last point here is, does the economy have room to grow? We have a 25-year runway. So you got clean balance sheets, you got a supportive enabling environment the regulator has set up, and you have room to grow headway for the next 25 years. What more could you ask, Nikul? So I think the banking system should be set to grow. I'll add one more. You are working with, I think, technology, I would say, advances, which again are so exciting. Banks could do so many things with the new technology available. At what I call free mein milta hai. All these technologies today are virtually free, or you can actually beat down the guy across from you to get what you want at a very low cost. So banks, I don't think have ever had it so good.
Right, Dhaval?
So, sir, just wanted your thoughts on credit growth, and also if you could talk about is the large big bank capex in the country. If you look at since 2015 or entire last decade, we've not had any big large projects being announced or sufficiently done. And also, where is the disconnect according to you, maybe between the delivered balance sheets and the capex recovery?
Several questions in this. So let me take one by one. The large one was the disconnect between the delivered balance sheet and the capex. What I think we need to understand is how has demand been met? The demand has been met through all these years, as we are now gotten to a 3 trillion economy and are looking to a 5 trillion economy. Everybody says that the key area of spend is infrastructure. So I'll keep that aside for a moment. But let me put it in context. There are 4 spends that happen in an economy with a 25-year runway: water and agriculture, infrastructure, manufacturing, and in our context, given the push and the drive, the digital economy. These are the 4 areas where spend will happen. The big spend that you are mentioning possibly is in infrastructure and manufacturing, because digital is self-financing itself so far through equity, mostly coming in from abroad or some supplemented locally. So we're talking of infrastructure and manufacturing. Infrastructure, the big ticket spend has been by the government. And that is a consequence of what has happened over the last 10 or so years, where in a way the private sector and the banks burn themselves for a variety of reasons, which we may not go into. But I would think primarily assumptions made went wrong for a variety of reasons. Again, time is too short to go into this. So infrastructure will be led, as I can see, by the government, the big ticket spend. And part of it may come onto the balance sheet of the banks, but not the entire bit. Part of it could come from the marketplace. Then comes manufacturing. The manufacturing side, what has happened is that if you look at during the same period, the last 3-4 years, what has happened to the corporate balance sheet? Corporate balance sheets have been deleveraged completely. You know as well as I know that the year 2000, leverage was 3.8:1, debt to equity. 10 years later, it became 1.8:1. Today, it is virtually nil. If you look at the top 200 or 250 companies, well, a smattering of debt here and there. So what is happening? Corporates are throwing up free cash, which is going into, I would think, putting capacity at the margin. That is through, not greenfield projects, but through brownfield expansions, which is met through cash equivalents. The greenfield guys are still coming to the institutions of the banks, and these would be your large investments like in steel and so on. But even there, the leverage is completely different than from the past. So I would think a degree of patience is required here. A variety of projects will happen as this capacity gets used up. And as we move definitively from a 3 trillion economy towards a 5 trillion economy, a whole lot of investment will happen. In the meantime, last point that I want to make here, banks are not idle. My belief is banks will still grow at a 1.25 to 1.5 times the GDP growth rate. Some will grow higher, some will grow lower. Why is that? Because new areas of, I would say, activity with the banks are opening up, which my generation, it was not happening. Say 20 years back was not there, or was just fledgling. You know what I'm talking about. I'm talking of the retail customer, where say you are also serving that customer in a variety of ways. Did we have that sort of flows that you are having today into your businesses, 20 years back? They were a trickle. Today, it has become a flood. So also has been the need for funds, become a larger for retail opportunities, whether it is homes, whether it is something to put into your home, things to move, or just to improve your lifestyle, as long as you can support it to your earnings. So, and that's the market the banks will go after. So these are all things in transition. These are all signs of what I'd call a resilient economy. And we should not look at just one indicator of offtake, that is big ticket items. There is a whole lot of things which are today pushing the growth agenda.
So, Mr. Kamath, how exactly do you think this credit cycle will be different from the previous credit cycle? Previous credit cycle, in a sense, was led by commodities, steel, cement, power. Corporates have learned not to overcommit, not to over leverage, and the economy is coming back. So how do you think the cycle would be different purely for the BFSI sector?
That's a very interesting question. Throughout my time in banking, neither the corporate was having the degree of cash flows, free cash flows, that one would have liked to see. Myself as a banker and the client himself. So, if you remember the old pattern, 20% equity, 80% debt. That is, incremental project was funded with 20% of what's called promoters' contribution, 80% debt. It was not because that was the ideal structure. That was because there was no other way you could have funded a project. And I'm going back now 40 years, 50 years into how it was done. In the last 10 years, that has been dramatically corrected. And I'll come back to that in a moment. And so has the cash flow of the retail borrower. 20 years back when the housing loan and the credit card cycle and the car loans, all these got off. The lay customer also was, in terms of surplus cash, a trickle. Today, his own, cash flow has improved. So both the bank's corporate customer and the bank's retail customer have much healthier cash flows today. So to me, that is the signal change between even 10 years 10, 12 years ago and today, in terms of what is happening in the system. And that augurs well when you're again also looking at a growth in terms of 8 to 9%. And I always love to say, you add the digital pie on top, that's 1/3 of what it is in some of the other economies. Even if it is 25% for us, or say a third, we're talking of double digits comfortably. Double digits should throw up banking growth of almost 13 to 15%. And of course, then you can work what should be the economic trajectory. I think it should be as fast as what the government has in mind.
Just a question here is on digital capabilities. What do you think, basically, where is India compared to Western countries or the other emerging market countries, especially the digital capabilities with respect to banks and also maybe the entire industry, all the other industries as well?
There are 2 or 3 factors to be looked at here. If we look at history, we were always with a lag of 5 to 10 years in getting technology. Up to 96, technology could not be gotten freely, duties, taxes, and so on and so on. But then there's a lag. In the last 10 to 15 years, that lag has become virtually dead. There is no lag at all. It is real-time technology transfer happens. It's on one part. Second is our capability to develop technology. Till a few years back, our capability was to be the software doctor to the world or the software engineer to the world. But today, if you look at the startups that have happened, these have all played with technology and set up, I would say, platforms. I'm using the word in a much broader context than people tend to use, which are of value to end user and then the customer. And when I look at the platforms, it's very clear to me, whichever business, whichever area, just digitech, fintech, whatever, you see one thing very clearly. These are full of value. So they have managed to embed value into the platform, which is, the skill of and the mindset of these new startup companies, and you have to commend them and laud them for it. There's a separate problem. If you want to discuss, we can discuss it now or later on. There's probably a gap, I would call it a chasm, between the value they have created, which has undoubtedly been created, and the valuation expectations that have been set in the market. And I don't want to go down that route. You are much better equipped than me to look at it. But I would look at it my interest in technology at the value that they've created in the platform that each one has put on the table, as it were, it's stupendous. It is absolutely fit for purpose. So that momentum that we have in creating these things is something new. We will create platforms initially for India and then for the world. Let's take one simple platform I think is fit for the world is UPI. UPI to me is a game changer around the world. And we can be all proud that it is an entirely homegrown product which has stood us in great, use in the last 2 years. And I think is ready for the world.
Since we have a very large attendee audience here, I just want to bring out the fact that automatically changes the India stack. And the finance minister, has indicated to us that also increases India's ability now to negotiate globally with this kind of technology powerance in terms of patents and other things. But Mr. Kamath, if I paint the lay of the land for the banking sector, PSU banks were forced to consolidate. Private banks are trying to consolidate. What is the future for banks with smaller size? The problem there is size, not governance, not talent. But will smaller banks in the relevance be reducing, and will they get marginalized as we grow?
Yeah, it's a very interesting question. There are two parts to this question: threat from bigger competitors and threat from even smaller competitors, but who are pure play technology. And both threats are relevant. We talked of UPI, it's a scalable model which anybody could use. And NewCo, a new start bank, would today, in terms of technology, be spending a fraction of what the medium size of the large bank was spending in the past. So given this, the competitive stance that the small size or the mid-sized bank will have to work out is, how do you basically establish your relevance in the field? And that can be done only through three things that I could use. I have learned. One is use of technology. Are you as skilled or better skilled than the NewCo in use of technology? You have to be at least as skilled. And at least, can you compete with the big guys in terms of technology? Probably you can implement technology even better. So that is key. Number one. Key number two is what is your capital? How are you going to get that incremental capital that you're requiring for taking on the challenge? Particularly of the larger banks. Here, not so much the smaller banks. Smaller banks on the technology front, the bigger banks on the capital front. If you have equated these two, and as you said, governance is on par, it's as good as best in class, then you will prosper and grow. Otherwise, you need to work out what is your path. Could be a consolidation path. You actually gave a clue in the opening sentence. Give that consolidation a clue. And these companies would have to look at consolidation, maybe with a gentle nod, a gentle push from the forces around you, that is the market forces, the regulatory forces and so on, to create size. But I think resilience is required in this banking, because otherwise you're going to be hemmed in on both sides.
So just to take it forward, sir, means recently a big HDFC group has announced about the merger. Your thoughts maybe on the same. Also, I wanted to understand the NBFC sector, right? There are few companies which are becoming fairly large. Maybe Nikunj also wanted to mention about that. Do you think that the way out for even most of the NBFCs will be converting into a bank?
The first point, the mergers that could happen, or the merger that has happened, that is a welcome move. The way I look at it is, which most analysts have not talked about. To me, as a banker, the significant competitive strength that is derived from this merger is the capital base. I have not done the sums because I am not privy to what the netting effects are, but given the numbers that are on the table, we are looking at equity base of around, or a net worth of around 3 lakh crores, give or take a few 10,000 crores, which is not going to be of relevance. But the net worth is going to be the largest in the system, which gives you capability to do a whole lot of things. Now, what the merged entity wants to do is up to them to take a call on. But they have got the size in terms of net worth. I think that comes first. That allows you a lot of things. That allows you the ability to grow your balance sheet. That allows you the ability to inject technology as you want it, and do a whole lot more to get going. So that first step has been taken. More importantly, we needed as a nation to have banks of a size which will support a 5 trillion and a 10 trillion economy. And I think this creates that sort of a footprint to start with. And we need a few more for this size to really drive this country to the 5 to 10 trillion goal that we have. So to me, this is a welcome move. You asked the question of NBFCs. I think that's a trickier one. The trickier one for this reason, we need to understand there are several things in play here. Don't go by the market cap. I think the market cap, if you're trading at over high double digits, then you need to be very cautious, I would say. I would again go to basics. Is my capital structure right? Is my leverage right? Do I have sources of funding that will sustain and let me meet my aspirational growth? My aspirational growth, in this case, could be higher than the 12 to 15% that I mentioned. Because then, do I know how to manage risk? Is it the risk system or the structure that I have got adequate for the size I have? Lastly, as I grow, will I throw up enough cash flows to get my valuation right? Because the risk is again the same that I mentioned earlier. That is, you might have created something of value, but is your valuation in sync with value? To me, valuation is basically a tool to create value. But then you need to be sure that you don't outpace the growth. And you have seen this in the past. A good market valuation is a good point to get additional capital and bolster your asset. And then build the free cash flow and the profit so that you have got a proper ROE. So there are several moving parts here, and you cannot give one, I would say, straightjacket answer. And I was not speaking of any particular company. This should be true of all the aspirants who are getting into and aspiring to be NBFCs. There's a place for everyone. Now, whether you want to continue as an NBFC or become a bank will depend on your aspiration. If your aspiration is to grow at a very rapid pace, you may find that competitively cost funds are not available. So you might then be forced to look at becoming a bank yourself. Or if you build a size too quickly, which in a regulatory context causes some, I would say, discomfort in the regulatory mindset, then you may need to again look at what is the wish of the regulator. So there are several driving forces here. Just a single force we cannot take and say, yes, they have to become a bank, or no, they need not become a bank.
Mr. Kamath, the mega trend in last 20 years has been this value migration, and you wonderfully alluded to very early 10, 12 years ago that credit is moving from the PSU banks to private banks, and that is happening incrementally on a yearly basis. But given that there is a consolidation which has happened in the PSU bank, State Bank of India is a success story in terms of digital adaptation. Do you think now the maximization market share shift has happened and PSU banks can also make a comeback? I'm asking a private banker to say nice things about PSU banks, but is it possible?
So it's not a question of saying nice things. I think I will go by what are the facts before. The facts are all banks are clean, including the PSU banks, in terms of their baggage that they had for a variety of reasons. They are adequately capitalized. I think there is a base level of technology today which is not differentiated. I can't say that a private bank has got better technology than a public sector bank. So what then needs to what we need to look at is and that customer's aspirations growth will happen. I'll tell you a small story. When we first went into retail banking, we saw some numbers which were very telling that the aspirational jump that was happening in the Indian economy was every year about 25 to 30% of the people were jumping from one category to another. So very simply, if I had a black and white television, 25 to 30% of black and white television owners wanted now to or aspired for a color television. And if you had a 21-inch color television, you then aspired television. You had a cycle, you aspired for a motorcycle. But in overall terms, you were jumping at a significant pace, which was unheard of. So I would think that that is going to happen even now. And that is why retail will be a large piece of the banking sector.
Mr. Kamath, the follow-up question here is that banks and private banks spreads which they've enjoyed in the mutual fund industry, credit card business, even by selling mutual fund. Now, whether it is regulation or fintech, that entire fee-based chain is getting attacked. A variety of fintechs are attacking them. That's a large differentiating component. How will that change in coming years?
Absolutely right. And that is part of the resilience. And I said one stack is already gone, which was payments, which was giving you a nice cushion, as it were, or a ride, as it were. That's gone. And banks will have the ability to price appropriately. So the competitor also now, in the last 6 months, has got a wake-up call. That is, the NUCO has a wake-up call that ultimately in life, free cash flow pays. If you don't have, I do not want to use the word abandoned, but you'll be left on your own to fend for yourself. So before
To private banks?
Yeah, three mantras that I said earlier on. Use of technology, they are very good at that. Capital, which is of a size which is of use and can be used to compete. I think they're yet to get there. Some of them have got market valuations, but that has to be translated into cash on the books or equity on the books. Not happen. Most importantly, generate free cash flow. So the last one is the critical. If they can decipher that and generate free cash flow, then I think everybody has to sit up and take notice. It's now very clear. If they don't, somebody will lead them on up to a point, and then question mark as to what do they do next.
Mr. Kamath, something which we've discussed in the past, but just for the benefit of attendees, you look at a lot of global examples, and let me draw parallels from other industries. There is an Apple which has defined the logic of big numbers, and there's a Tesla which has disrupted the oldest and the most competitive industry in the world. So for the banking sector, what to your mind could be the Tesla moment?
The Tesla moment will be a bank which is of a certain size today, which is puts it in let's the top 7 to 8 banks in the country, and is able to play with technology like either an Apple or a Tesla. That is absolutely facile in use of technology, low cost technology, disrupting old technologies, and so on. This ask is a little too much, Nikunj, because that guts any incumbent, not only in the banking business, any incumbent doesn't have, because the question of what happens if something goes wrong will be always there at the forefront. So I would say that the likelihood of a Tesla moment coming from an incumbent is going to be, could happen, but is a big, I would say the odds are stacked against because of this embedded mindset and the fear of change, as it were. So it has to essentially come from a new co, which is able to meet the other 3 tests. That is, put in capital, of course, they are already players, easily play with technology, and are generating free cash flow. And actually, if you look deep, there are a couple of companies in the financial services business who are already doing that. That could be a model for, and in the businesses they are in, they are already market leaders in a very short span. Particularly in the last 3 years, they have scaled up dramatically. So,
if I can just have one more follow-up question, Dhaval, with Mr. Kamath. Yeah. Just a trend, Mr. Kamath, which in a sense has now becoming more like a global best practice. Global banks are very conscious about ESG lending. Bank like JP Morgan has said, we will not be lending to thermal plants now. But looking at the way our energy shock has come and where energy prices are going, greenflation has come back. Do you see things changing again on the ESG front, the way banks would be lending and what it means for India?
Let me not look at it from the bank's point of view. Let's look at it from a larger point of view. It'll take only 1 minute. And that answer, then that will be the answer to the markets, not only the banks, but the entire market. Energy shock has shown us how fragile the assumptions that you have made are. ESG is a wonderful thing and we should drive it. But on the energy front, the question is, were we running too much ahead of what we had already created? And this shock has very clearly indicated that yes, we were. So I think while making sure that the environment is clean and so on, so forth, I don't think that we could abandon the energy, the fossil energy as quickly as we thought we could. This is one. I will just for the sake of completing the picture that I have in my mind, also put in another thing, Nikunj, which will play out in the next, immediately in the future. And that is this rewriting of economic theory, that interest rates in an inflationary context have to be set at a level which reflect real interest rates. Okay. Now, I leave a question, is that what is reflected in the US? Is that what is reflected in Europe? And as a consequence, what bearing does it have in the future? Now, as far as we are concerned, I think after a long time, we can say our interest rates are very near real interest rates and definitely higher than forecast interest rates. But that's not so in the 2 of the largest, I would say, sectors, economic areas, as we say, Europe and the US, where new economic history might have to be evaluated. How do you manage high inflation with low interest rates as you go along? And what lessons does it have for us? To me, the lessons are good. I believe you can manage with low interest rates because the relationship between interest rate and inflation was never clearly established. Maybe it was established 100 years back. After that, there have been too many moving parts. What does that mean to all of us? And I'll leave it on that. I hope that we will have low interest rates, both corporate India and retail India, which could do good to them individually, companies and individuals, and also to the nation.
I'm going to shamelessly extend with one more question. I know we exceeded our appointment with Mr. Kamath. And Mr. Kamath, this is something which I've always been wanting to ask you. If KV Kamath of 2022 meets KV Kamath of 2000, when he had a different mindset of about growing ICICI Bank in terms of scale and size, and you have to write a letter. KV Kamath 2022 writes a letter to KV Kamath 2000. How will that letter start and how will that letter end?
I'll put it simply. It is decisions taken in 2020 were taken in an environment where I had no options. And Today, you have plenty more options, and we need to evaluate those. Because we were in a, we won't go into it. The challenges that were there in the development bank of that day, primarily no funding available, and the march of technology, and on the other side, asset quality problems that were surfacing, meant that you took certain risks which you might otherwise have hesitated to take. So, but those days, you were up against a wall, and this was the only opportunity, and we took it. And in a way, the capital market helped us with the first DDR, the next ADR, and the retail market also took off, and we could ride that bandwagon. But that was taken in the context of the environment 2020, and I would caution KV Kamath that in today's context, you have to look at it in a different context, the context of a 25-year runway and all that has happened around. And probably you have many more choices. But, it's going to be an interesting time all the same.
Also, you managed to make an unknown franchise, an unforgettable franchise, which is ICICI Bank. So really appreciate your time. Thank you so very much for joining us. Dhaval Gala, thank you very much. I must say that you've been a lovely co-anchor. I can already see competition coming in if you ever decide to do television anchoring. But thank you very much. And Sumit, with that, I'll hand it back to you.
Thank you.
Thank you.
Thank you very much for that, Mr. Kamath. Thank you, Nikunj, and thank you, Dhaval, for that very interesting session and the start of day 2 of Voyage 2022, our 9th edition. All right, we've been having a lot of questions coming in. Unfortunately, we couldn't put them all to Mr. Kamath. We will be requesting you to continue sending your questions as throughout the day for the different sessions. The feedback, the rating feedback pop-up must have come up on your screen, so please do rate how you thought the session was. Moving on, let's go on and continue with our next session. Now, over the last 2 years, India's investment habits have changed. Now, people have become more aware of non-traditional financial assets. So, under the current scenario, how has the fixed income space fared? Well, to talk more on that and on the market outlook for fixed income and credit, we are being joined by our next 2 speakers. We have Sunaina Dakuna, co-head fixed income at Aditya Birla Sun Life AMC Limited, and Bhupesh Bameta, fund manager fixed income at Aditya Birla Sun Life AMC Limited. They'll be sharing their presentations, following which they will be in conversation with ET Now's Aisha Faridi. So let's start with the next session.
Hello, good evening, everyone. I'll be sharing our fixed income outlook of our fixed income team. I'll begin with the global macro, it will be followed by Indian macro, and then Sunaina will be taking the credit part of the deck. To begin with, if you have to just analyze where we are currently, we have to step back a little bit to see what happened in the last 2 years, because a lot of unique things happened in the last 2 years, and which are a key reason why where we are standing right now. So COVID was a very, very unique recession, a sui generis recession. So typically, if you look into recessions, we have typically 6-8 quarters of downturn, and then again 6-8 quarters of upturn. But this COVID recession, it was a sharp recession. In 2 quarters, we reached the trough. In the next 2-3 quarters, we are already now back to the pre-COVID levels. Again, it was the broadest recession in terms of number of economies that went into recession. Largest ever number of economies went into recession. In terms of GDP degrowth, we had the sharpest degrowth since the World War II. But again, another unique thing about this recession was that throughout the recession, we typically keep on getting negative data surprises. But in COVID, almost through the entire pandemic, the data surprises kept on being very, very positive. Reason for that, number one, aggressive rate cuts, the monetary policy. The policy response to the recession was quite phenomenal. Monetary policy came out with a bang. We had aggressive rate cuts across the board. You look into any major EM economy, the rates went sharply lower and much lower than what they were in 2008 global financial crisis. Also in DM economies, they straight away went to zero. Rate cut for the first part. The second was aggressive quantitative easing. Balance sheet zoomed across the board. Much higher than what we had in the global financial crisis. Closer to $10 trillion of balance sheet expansion took place in the last 2 years only in the G5 economies. The result of that, we had a booming monetary policy, booming money supply pretty much across the board, and again much higher than what we had in the global financial crisis. The fiscal was the first part. The second part was in terms of the monetary was the first part. The second part was fiscal. Aggressive, very, very aggressive, I would say, fiscal policy response. So I'll just give an example of United States. For every 1 unit of GDP loss, the amount of fiscal stimulus that was given was 3 times. That was the level of fiscal response that came out. Global GDP went up by 4% point just because of the fiscal stimulus. How it differs much more than from the global financial crisis, the fact that in global financial crisis, immediately after crisis, we had a sharp fiscal contraction, but this time it appears that that the fiscal contraction is again going to be a very gradual affair. So net aggressive monetary stimulus, aggressive fiscal stimulus, and a lot of it persists. The result of that, potential gap closed very, very quickly. Again, have this reference of global financial crisis, how gradually the potential gap closes. This time, almost pretty much across the board, we had sharp closing of potential output gap. And market rallied pretty much across the board. Global equity markets had the best runs in many, many decades. Household wealth linked to both financial assets and non-financial assets zoomed pretty much across the board. In a country like US, household wealth zoomed by up to 80% of their GDP. Same with similar big jump in household wealth also in Euro area, UK, Canada. Also, a lot of the fiscal stimulus which was given was largely saved by the households, and the result of that was that household saving also, rose across the board. So household balance sheet improved dramatically. Consumption, if you have too much of money coming out, a lot of it free, consumption zoomed pretty much across the board. You look into US, significant jump in consumption. Look into Euro area, again, very strong jump in consumption. Pretty much similar story was there in many of the other DM economies also. Global unemployment rate fell significantly and quickly went down, below the pre-COVID level and also below the, in a very, very long time. The result of that was that we had big jump in inflation. You look into DM economies, EM economies, globally, everywhere we are seeing a big jump in inflation. If you look into this graph shows the percentage of economy which are having inflation greater than 4%, and see this wallet graph, big jump over there. So pretty much sharp uptick in inflation, not only in terms of intensity, but also in terms of breadth. So pretty much everywhere we are seeing pretty high inflation. Now the current scenario is that the key market of the reserve currency US, the job market is red hot. For every 1 unit of loss of, for every 1 person looking for a job, there are 1.7 vacancies available. So wage growth has been spectacular over there. Unemployment rate and also fell sharply. Just to give an example, give you an instance. So there are only 3 months in the last 50 years when US unemployment was lower than what it is right now. And that is, 2 months 2 months ago, we had this sharp recession. So that was that just reflects the ferocity of the pickup in growth that we are seeing, that we saw particularly in US. Fed fell significantly behind the curve in the sense that inflation went up very sharply. Growth was pretty strong. If you look into the real policy rates, they are the lowest ever in the last 50 years. So, just look into this green line they show, but where are the Fed rates and where is the inflation? And there's a big gap over there. If you compare with the Taylor rule, the current rates current US Fed rates are 7-8% lower than what they should have ideally been. Similarly, in the ECB, I think they also much behind the curve. Inflation has zoomed also in ECB throughout the Eurozone, and even in conservative economy like Germany, where we are seeing closer to 8% inflation, Spain very high inflation, and again if you look into real policy rate, deep negative over there. And just a few months ago, they were, even in this high inflation, they were also increasing their balance sheet, just to show how far behind both these big central bankers have fallen. And if you think these were the only two central bankers, no, have a look into broad spectrum of central banks across the world. Real policy rates are pretty much negative in most of the major economies. Look into Argentina, Brazil, pretty much everywhere. In India, they're also again negative, but a little bit less than what they are. What's the median negative real rates? So, because central bankers are much behind the curve, the markets are pricing a very aggressive catch-up. Pretty very aggressive rate hike is being factored from the US Fed. Even if you compare from January, but in January, markets pricing of Fed rate hikes have gone up by closer to 200 basis points. It's very rare to see in an economy so well covered that market expectation of rate hike goes up by 200 basis points in less than 3 months. So a big jump up in market expectation of rate hike, not only in US Fed but also in ECB. Again, from a central banker as dovish as ECB, now markets are factoring in closer to 200 basis point of rate hike in the next 2 years. So that shows how much catch-up market thing is going to happen across central banking space. And not only in terms of rate hike, but also in terms of balance sheet contraction. Also, yesterday we had this Fed minutes, and that showed that Fed is now planning to reduce their balance sheet by close to $1 trillion per year. That's the level of monetary policy tightening that is due in front of us. The result of that has been that yields have surged pretty much across the board. Looking at DM economy, bond yield, big surge. Same for EM economies. And what we're also seeing is that a pickup in bond volatility. So because markets were caught, I would say both central bankers and markets were caught unawares in terms of this inflation flare up. Therefore, there's a big cash up happening in the bond markets. Now let's come to the Ukraine crisis, very proximate thing for us. In terms of its impact, number one, its impact on GDP. World economy impact is expected to be little above 1% percentage point of GDP. The impact will be mostly in the euro area and somewhat lesser in non-euro area economies, simply because the connection of euro area has with Russia. In terms of inflation, its impact is likely to be significant at 2.5% across the world. Now, the thing about Russia is that Russia is not a very major economy globally. It only accounts for, Russia plus Ukraine totally accounts for around 2% of the world GDP. But in terms of its, commodities, they are a very, very big players. You look into all the rare earth metals, energy, both oil and gas, wheat, agricultural products, wheat, sunflower oil, fertilizer. They are very big players over there. So the result of that, we are seeing a big surge up in commodity prices. They have reached the highest level in a very, very long time. Also, food prices have surged pretty much across the board. Crude oil, we are already, a lot of media coverage of that. It has also surged significantly, same with the natural gas. Again, in terms of exposure to Russia, most of the exposure is for euro area, except for, those markets which are more global in nature, for example, the commodity markets. However, despite this big surge in commodity prices, in terms of the financial impact, the financial stress indicator suggests that the level of financial stress which this crisis has caused is significantly lower than what we had seen in the other major crises. So some stress is there, but it's still broadly contained. You look into VIX, which is the indicator of equity market volatility. It is pretty well contained. You look into credit default swaps. It has risen somewhat, but not significantly. And EM's financial stress indicators have risen somewhat, but still quite less than what they were in beginning of COVID or in many of the past crises. So the financial stress has been quite muted. Now let's come to the pandemic. The pandemic is varying pretty much across the board. We are seeing sharp fall in cases, except for China, where we are seeing a big jump in cases. If you scale it, the numbers are quite low compared to many other economies, but still, because China follows a zero COVID policy, so that's a big worry. This chart shows the level of risk aversion which different economies have to COVID, and here China, Singapore, all these, and South Korea, these economies come right on the top, which means that even the small jump in cases in COVID cases in China can have some impact on global growth and global supply chain, because China is such a big player. We are already beginning to see this impact of zero COVID policy of China. There, if you look at the PMI data, it has fallen sharply, both the services PMI and the manufacturing PMI. And if you do a cost benefit analysis of how China has fared through this pandemic, so in the initial 2 years, the sense is that China's zero COVID policy, because it was able to contain the pandemic, did net it was a positive for the global growth. But what we are seeing right now is that at this juncture, this Chinese zero COVID policy is likely to be negative for their growth in the world economy. So that's one thing you have to contend with. That broadly, the pandemic is now winning pretty much across the board. But China is one economy which will have some more, which will have this impact going on for some more time. Coming to India, so compared to the global policy, we have discussed how big surge in how big monetary fiscal stimulus was given. In India, it was much more modest. You look into the RBI balance sheet, it did rise, around 4% of GDP and went to the highest level in a very long time. But still, you compare to the other major economies, it's a pretty modest increase in the RBI balance sheet. You also look into the government fiscal stimulus that were given at 3.5% of GDP, much lower than the DM average of 17%, US value of 25% of GDP, and just closer to what we had as the EM average of 4.1% of GDP. So in terms of the policy's response to COVID, we were much more moderate, you can say much more conservative, and and the result was that the recovery that we are seeing is also much more modest compared to what we saw in most of the DM economies. So last year we had this growth uptake of 8.9%. Now, but don't get confused with this high optical number because we had this very strong base effect in last year and also in this year. So a better way to look into GDP growth is compare it how GDP growth could be on a CAGR basis compared to FY20, where most bases are not there. And there we see that in FY23 we are on the more bullish side in the spectrum. But we also think that India's GDP growth is likely to go up by only 3.5% if we remove all the bases. Obviously, the headline number will be closer to 9% is the view. There are some downside risks to that, especially, we are assuming that this the hot part of this Ukraine crisis will go away in a couple of months, while the sanction, etc. can linger on, but we can be wrong there. And if this crisis the hot crisis linger much longer, then we can have some further downside to GDP growth. However, if we compare how India's growth is faring compared to the pre-COVID trend, we are still around 7% lesser than what we were in the pre-COVID trend. In economies like US, we are already back to the pre-COVID trend. So that's one thing to keep note of. The good part is that recently, because COVID is waning, we are seeing a big decent jump in economic activity. And the big reason for that is that the pandemic has subsided significantly. If you look into this is the lockdown index. It's a globally cross-country index which tells you what is the level of COVID restriction that we are having. So India's COVID restriction are now almost closer to zero, which is we are almost back to the pre-COVID levels in terms of restriction, and that is showing in the plethora of all these high-frequency indicators showing a decent uptick. Within the economy, we are seeing somewhat of a K-shaped recovery. The organized sector is doing much better. You look into the payroll additions, you look into the EBITDA of listed companies, the companies which RBI tracks. You also look into the credit ratio, the upgrade and downgrade. All are showing that at least the organized sector is recovering faster. That this also reflects in the very decent, robust tax collections, which have grown. The 2-year CAGR of the tax collection have go to the highest level in more than a decade. So in the previous slide, we discussed how India's growth is still 7-8% below the pre-COVID trend. But if we look into tax collection, we've already gone above the pre-COVID trend. And a lot of it is because of, I think, better compliance. If we just look into GST, the percent of GDP, GST collection, the percent of GDP, we are now steadily improving. So both a result of, I would say, greater formalization, improvement in GDP growth, as well as better compliance resulting in decent tax collections. The flip side for India is that the consumer confidence is very low. Over the last 7 years, so we had 3 stages of India's growth. In the first stage, we had big jump in fixed capital formation, as well as decent growth in consumptions. Same was the case in the second leg. In the third leg, since the last 7-8 years, most of India's growth is coming from the consumption side. And here, the problem is that if this consumer confidence remains so low, it will be a drag on India's growth recovery. Having said that, we do expect this consumer confidence to recover gradually as COVID drags, wanes, but it will still take some time. That's the reason why we are also considering more modest GDP uptake from the current levels. However, conditions are quite good for capex revival, but capex typically follows consumption. So while the supply side of capex revival are quite strong, industries have deleveraged, banks are sitting in a lot of fund, banks' capital adequacy ratio have become quite decent. Companies have also raised a lot of funds, but the problem is that with consumption so on the weaker side, it will take some time for the capex revival to play out on the economy. Other important fact, data to ponder for us is the inflation. Inflation pressure in India has remained quite elevated. It is somewhat lesser than what is there in the DM economy, but still, at closer to 6%, India's inflation is very uncomfortably close to the RBI's target band. Also, inflation expectations by household, which is a good indicator of inflation coming ahead, still remains quite elevated. If you look into firms' input prices versus output prices, we see that there's been a big jump in input prices of firms, which again means that output price pressure will remain elevated in the forthcoming future. So inflation is one concern that economy is currently facing. On the positive side, our food stock is quite abundant. If you compare the food stock compared to the buffer norms, we have significantly, 4 times the buffer norms in terms of rice and about twice in terms of wheat. So earlier we discussed how the Russia-Ukraine crisis is resulting in flare up in commodity prices, also in flare up of food prices. But because India has decent buffer stocks, so the immediate impact on India is likely to be somewhat muted, except for a few commodities where we are big importers. For example, palm oil, generally oils, we are a big importer, and Ukraine is a big exporter of sunflower oil. And secondly, I would say pulses is another segment where we are big importer. Otherwise, because our buffer stock is quite strong, we don't foresee a big sharp jump in India's food prices because global prices have gone up. Having said that, the problem is that whenever we have this big jump in commodity prices, big jump in fertilizer prices, the input prices of the farmers go up, and as you can see here, farm input prices have gone up significantly, and this flows into the MSP prices, which government sets. So while the direct linkage of this rising global commodity prices won't reflect immediately into India's food inflation, but over time to this channel of MSP, this should start having impact on inflation. So net inflation pressure are elevated, and they remain a risk to watch out for. For India, the impact of Ukraine comes from, one, most importantly, from petroleum trade deficit, petroleum crude oil. We expect, so all this calculation is assuming $100 per barrel crude prices. In that scenario, we see a big jump in India's petroleum trade deficit from closer to 2% in FY21 to 2% higher, closer to 4%. That will have a big impact both on the CAD level and also on the monetary policy and the GDP. That's one segment. The second one, is in terms of fertilizer prices, which have gone up significantly. And India imports a lot of fertilizer. And government has promised that they will keep the fertilizer prices stable, which means that it will have a big fiscal impact. In terms of direct impact of global food inflation, as we see, except for edible oil and sugar, in most other segments, food aggregate, India's correlation with global prices is not that strong. So, global food prices will not impact India overall, except for certain segments. However, there's some impact is going to come via FII flows, which have already turned negative. That's one segment which is going to have a negative impact. The second one, as we know from FII, we know that external account will be under some pressure. We are already seeing, because of higher crude prices, we're already seeing big jump in India's trade deficit. And we expect that India's CAD is going to go up to around 3.5% of GDP, which is a significantly high number. India's comfort level is around 2.5% of GDP. So that's one source of problem for India. So for India, the external account is a debate between the flow and the stock. Now, while the flow has actually turned quite adverse, one can say, but the good thing is that over the last 2-3 years, RBI have been accumulating a lot of reserves, and India reserves are quite significant, and they will ensure that we don't have any run on the currency like we had in the taper tantrum or toward the GFC. So while it means that we can hold on to this higher CAD for some more time without causing any big macroeconomic stress. Just to compare where we currently are compared to the global financial crisis, just have a look. In terms of current account, we are significantly worse. In terms of overall BOP, we are somewhat worse. But now this is very interesting. So now we have discussed that India's real rates are quite negative. A lot of people are complaining India's real rates are quite negative. But what matters for the currency, for the BOP, is that how India's real rates are compared to the US real rates. And here we see that we are significantly, if we do a differential of Indian versus US real rates, we are significantly positive compared to the US real rate, which should result in FII not leaving India in bulk. So that's one positive thing. Second, as we had discussed, that FX reserves in India are quite comfortable. So net, some source of concern, but no, I don't think it's a outright big concern as of now. But if this pain persists for some more time, a few more quarters, then I think some big correction in currency or other macroeconomic parameters will be required by the central bank and the government. Okay, now what we are seeing is that gradually a credit growth which has been quite low for quite some time has begun to pick up gradually. Why it is important for fixed income investors is that because there's a very strong correlation that incremental credit deposit ratio has towards with the 10-year G-Sec yield. So this rising credit growth is one factor which we need to look very carefully in terms of its impact on the India's bond yields. Now, the bigger concern for India in that bond market has been that there's a big supply of paper which is coming from the government. There has been a big jump in fiscal borrowing. Government deficits have been quite elevated for the last 3 years. And this year, in the first half, government has planned to borrow 8.5 trillion rupees. Now, compare this to the total borrowing in FY20, FY19. The total first half borrowing is more than the borrowing that we had seen in the pre-COVID region. So the overall borrowing has gone up by around 2.5 times from pre-COVID region. It's a lot of supply of papers. To be fair, this supply was there in the last 2 years also, but in the last 2 years, there was ample RBI support. Closer to 30%, 20% of overall papers were bought by the RBI itself. This time, because the liquidity in the system is very high and because inflation concerns are there, growth is much better than the last 2 years, RBI support is likely to be somewhat less, and that will have its implication on the bond markets. And that is the reason why rates are going up. So real rates in India, as we have discussed, are quite low. Significantly lower compared to the I would say this current RBI regime has resulted in a sharp fall in India's real policy rate. Pretty much across the board, you look into weighted average lending rate, deposit rate. Everywhere you can see that the real rates have gone down significantly. And that is the reason why markets think that RBI is also much behind the curve, and they are pricing a very aggressive rate hike cycle from RBI. In the next 1 year, if you look into swap curve expectation, they expect rates to go up by around 200 basis points. So there's a pretty steep pickup in rates which markets are factoring in, and that is the result. And that has resulted in a very steep yield curve in India. Now the point to note for bond investors is that a lot of this hawkishness is already in the price, already in the yield curve. And our base expectation is that the actual rate hike from the RBI is likely to be much lower than what markets are already factoring in. And that's an opportunity for the fixed income investors. Now, this is one golden rule of bond investing is that this is for the US market, but it's pretty much same across the world. This says that if the rate hikes if the rate action by the central banks are lesser than what markets are factoring in those periods, fixed income give better returns compared to the staying in cash. And in periods where central banking rate actions are much more hawkish compared to what markets were factoring, it's only in those periods that fixed income gives worse returns compared to staying in cash. And as we discussed here, RBI rate hike is already very steep. RBI governor has been, went out of his way to say that they will ensure a gradual, withdrawal of monetary policy accommodation. And therefore, I think there's a lot of opportunities available for fixed income investors, depending on the time horizon, to have a suitable point in the curve and invest in the markets. I think I will end here. I think next to Sunena.
Thank you so much, Bhupesh. I will now take you through Indian credit markets and our view on certain sectors as well. Corporate India continues in extremely good health. Corporate India has used the last couple of years to delever its balance sheets. It's done this by, reducing its interest cost. And also it's increased its EBITDA margins given, the run-up that we have seen in terms of commodities, etc. If you look at a CRISIL credit ratio of upgrades to downgrades, you'll see in the last 18 months, a very sharp increase in this ratio, showing the fact that, credit health is actually very good. Same is in terms of the profitability ratios as well as the interest cover ratios, which is tracked and given out by RBI for about 2,700 companies. You can actually see that these ratios today are better than they were even pre-COVID. So from a credit health perspective, corporate India has never been in a better health today than it has in the last maybe 10 years. However, credit spreads have crashed, and that's because we've actually seen that over the last 1 year, be it AAA spreads, AA spreads, or single A spreads, credit spreads across have actually crashed because there's been fairly low supply of paper in the market and a fair amount of demand chasing yields, particularly higher rated papers. Now over to our sectoral views. In the financial sector, we've seen that growth has begun to pick up. Assets under management of NBFCs and housing finance companies have started to pick up across board. Also, collection efficiencies have improved across asset classes. In the second wave of COVID, we actually saw quite a bit of a downtrend. However, efficiencies have now improved, but they still remain below 100% levels. That kind of indicates that the overdues are no longer getting collected. So it will probably take a little more time to collect those overdues. We do believe that there is some amount of permanent scarring that has occurred in the Indian economy. If we look at both the balance sheets, the individual household balance sheets, as well as the corporate balance sheets, at the bottom of the pyramid for both households as well as corporates, there has been a fair amount of permanent scarring. And you can see that in the NPA numbers as well. Having said that, we think the worst of asset quality is behind us. Gross NPAs have peaked out, probably 2 quarters ago. And going ahead, there should be some amount of normalization of asset quality. A lot will depend on the restructured book, and that will determine the ultimate credit cost. Moving on to the infrastructure sector, in roads, we've seen that the pace of execution has actually slowed down last year, and that's primarily due to the various COVID waves as well as not so favorable weather. But FASTag collections have increased a lot and improved a lot, and that's primarily because of the tremendous amount of penetration that we've seen in FASTag across the country. NHAI's balance sheet has been stretched, and we have seen debt levels rise. However, they will do a fair amount of asset monetization, which is expected, and that's likely to happen through either the InvIT route or the TOT route, something that they've already started on over the last couple of years. We believe EPC and HAM models shall be the preferred mode of building roads going ahead, and we've already seen our NHAI take steps to ensure that this remains fairly competitive and reasonable margins are available for the players who remain in the market. In the telecom sector, while we believe that wireless subscriber level will remain range bound, the total subscriber base is expected to slow down. However, revenues are expected to increase, and that's primarily because of the tariff hikes taken by all the telecom companies. Also, the government announced a fair telecom package that came out last year, and as a result, the burden that was there on telecom companies with respect to stretched cash flows should actually improve. This year also, we should see 5G coming about, or at least the initiation of it. And maybe with that, with the auctioning of 5G, we may see some leveraging of telcos going ahead. In the real estate sector, when we're looking at residential real estate, after a lull of many, many years, we are finally seeing an upswing in the real estate residential markets. And we can see this even in the trend of new launches increasing and rising developer confidence. Unsold inventory has been dipping marginally, and that's because we've seen an improved pace of sales. Prices, however, remain stagnant, and we expect the residential market to build on these gains over the next few quarters. Interestingly enough, in the commercial real estate segment, also we've seen a fair amount of improvement, with leasing picking up with the the opening up of the economy, and new completions also leading to vacancy levels dipping marginally. Rents again over here have remained fairly stable, and there has been a fair amount of pickup in leasing, primarily dominated by the IT sector. Moving on to metals, in the steel sector, there has been a fair amount of impact on global steel prices due to the conflict in Russia and Ukraine. And Bhupesh did go into this in detail. And that's primarily because there's a fair amount of export that comes out of these two economies. But the impact will primarily be seen within Europe, but also on the overall steel prices that are experienced globally. In India, while HRC prices have gone up, however, the input costs of coking coal and iron ore have surged much more, and as a result of which we expect that there will be lower EBITDA per ton for steel players going forward, and the margins probably have peaked out. Deleveraging continues by steel companies. Domestically, a large number of them, the larger players, have announced a lot of capex plans. But unlike the previous cycle, which was debt-laden capex, this time round it's expected to be financed through a lot of internal accruals. In the non-ferrous metals, in aluminium, again, Russia and Ukraine account for a fairly large percentage of global export. But however, we do feel that with supply disruptions coming from the conflict, as well as constraints in Chinese production, we expect prices to remain fairly supported over the longer term. In zinc, despite everything, we expect prices to moderate. Over to the power sector, power has seen a fairly decent recovery in line with the economic recovery. As a result, we have seen, while deficits did drop, we did see some amount of fluctuation due to, issues with coal, as well as coal prices and shortages, as well as it coinciding with lower hydro generation at the same time. Thermal power projects are expected to see their plant load factors improve. But higher coking coal prices and the continued low level of coal that is there would be a cause of concern in terms of prices. As per COP21, India has a new set of climate targets, and we will look to increase our renewable capacity, where renewables in the overall pie will increase from the 20% currently to 50%. We expect that it will be solar generation that will play a very big part in this renewable generation, primarily, given the fact that there's a fair amount of variability that happens in wind generation. Some amount of good news came out of the Andhra Pradesh High Court, which would restore the sanctity of the various signed contracts, in terms of renewables, and it should give a boost to the arm of private as well as foreign investments in renewables. Unfortunately, with discoms, we have seen overdues creeping up again. This despite them falling due to the Atmanirbhar scheme about a year ago. But now again, they have started picking up. We remain fairly, comfortable and interested in transmission assets because there's a large opportunity that presents itself with the national monetization pipeline. We should get, a large number of these assets coming, as opportunities for investment in fixed income. And finally, to the automobile sector, we believe constraints remain, and that's primarily because of the sharp increase in raw material prices, high crude oil prices, and of course the continued chip shortages, in part now also because of the Russia-Ukraine conflict. If you look at the way the sector has actually performed, it's still well below its pre-COVID levels, and that you can see, across the board, with the exception of tractors. We do believe that OEMs will continue to prioritize their more profitable models, and they'll also try and develop models and variants that probably require fewer chips, given the huge amount of issues we've seen for one reason or the other over the last 2 years. In conclusion, we believe that the manufacturing sector has seen a fair amount of shift. You've seen from the small players of market share moving from small players to the larger players, from the unorganized to the organized players. We continue to like cash flow throwing companies and sectors which have a good track record, and promoters that have used a fairly conservative capital structure. And going ahead, we will continue to invest selectively in those sectors and in those companies. And with that, we'll open it up for questions.
Right. Sunena, Bhupesh, thank you both of you for sharing with us your in-depth presentation. Quite a few interesting takeaways, Bhupesh. First, if I could start off with you, because one has seen, like you made the point in your presentation as well, that in 2 years the markets, both equity as well as fixed income, have had to deal with everything starting off from COVID to war now. But at least for the equity markets, I can say that they have clearly climbed the wall of worry, right? In our lifetimes, we never thought that we were going to see such unprecedented times. We've really, been to the dumps and back and recovered extremely strong. We wanted to understand from here, because the dynamics from when COVID struck us 2 years back to now are very, very different. How do you now see, with crude at 130, now settling sub 100, the impact of the ongoings across the globe right now, both on the Indian economy as well as the Indian markets?
Yeah, thanks. Markets deal with a number of factors, and one important factor for equity markets is where growth is. For bond markets, inflation becomes very important. Now, let's look into this current crisis that we're having, the Ukraine crisis, and before this COVID recession. Now, the important point to note here is that for the last 2 years, what we saw was that growth had fallen significantly, but markets were doing very good. I mean, both the bond markets were quite happy, equity markets were booming across the world, and people were very confused what's happening. I mean, why growth is so bad while our market is doing so good. The key reason, I would say, with hindsight, we can say for sure, but at that time also we conjectured that was this extraordinary policy stimulus which had come from both the central bankers and from the fiscal side. Now, the problem is that whenever you give so much money into the market, there's always a payback time. And now, because of this very extraordinary stimulus, we are dealing with a lot of inflation around the world. And now, while growth is improving pretty much across the board, you look at the US data, European data, despite this, COVID, this Ukraine crisis, also in Indian data, the economy is improving pretty much across the board. But because, you had given earlier a lot of money to people and things have become overheated. So both the central bankers and I would also guess on the fiscal side also, people are stepping back from this stimulus. And what it will result in is that while people will again be quite confused to what is happening, why is it that economies are doing good, but markets are turning volatile. That's the one thing which we need to deal with. What we need to remember that over the last 20 years, I would say, every time, there was a different paradigm. Central bankers were always there. The classic central banker put was there pretty much across the board. Bad data was supposed to be good data. the entire paradigm is making a lot of big shift. Every month we are getting super high inflation, and central bankers now believe that they are behind the curve, and a big fast catch-up is taking place. So I think to do good in markets right now, only two people will do good, I would say. One who don't have any historical baggage with them of what's happened in the last 20 years, or the second group will be those who have this baggage over the last 40 years, where it's seen different cycles. So that's what I want to say is that we have entered a new paradigm, and the learning of the last 20 years aren't going to help you in the next, I would say, 10 years at least. So be prepared for that. Overall outlook for economy looks pretty good. But for equity markets, brace for some volatility. I would say same for bond markets also. They will be truly volatile time, but again, you will always find places where you can invest and get a decent return.
Sure. And I think a lot of it is going to actually become clearer tomorrow when you have the RBI policy. The Fed has already moved, and I think now all eyes are on the Reserve Bank of India, whether they're going to bite the bullet or not. But Sinana, if I could get you in on the discussion purely on the credit growth side of things, it's been rather tepid, if one can describe it that way. Is this a demand or a supply side issue? What's been your observation?
So I think it's a mix of both. Supply has been fairly low, and that's because, a lot of the issuers actually are sitting on a fair amount of cash, use the buoyancy in equity market to actually raise equity and delever their balance sheet. So they've actually not really gone out and raised much money. A little bit of this may be also because of fear in promoters. They've seen, in the last couple of years, quite a few fellow promoters, companies and groups going to NCLT, and the dangers of being over-levered. So, to some extent, it's a supply issue. Demand is there because, all lenders, be it, the NBFCs, be it the bankers, they're actually sitting on fair amount of liquidity, fairly cleaned up balance sheets, particularly the banks over the last few years. But most of them have gone and chased the high quality assets. They also have a little bit of the past hanging over their heads in terms of, when assets go bad, the kind of repercussions that can happen on their managements. So it is a little bit of a demand and supply side issue. We have, however, started seeing some uptick in credit growth, and with capex plans being announced by companies, hopefully the animal spirits return. Hopefully the virtuous cycle of credit restarts.
Sure. Bhupesh, looking at how equity markets have panned out in the last 2 years to the kind of scenario that we're currently at, and tomorrow, in all likelihood, we are going to see the beginning of the interest rate cycle actually change here in India as well. Does fixed income investment even make sense? Or should one really sort of stick to equity in this rising interest rate scenario?
So, 2 points here. One is in terms of asset allocation, we always recommend to investors that you should always have some allocation to fixed income, some to equity, gold, etc. There's typically a negative correlation between fixed income and equity. So typically when growth has fallen significantly, fixed income gives good return. So that's point number one, the asset allocation part. The fixed income should always be a part. Second and most importantly, as I discussed in the presentation also, so there are like three sources of return that you get in fixed income. One is the YTM, the carry part. Second is the capital gain parts, which is that, when bond yields go up, you get a capital loss and vice versa. And the third is the roll down part, which is, if yields are very steep and you've invested in a 3-year paper, in 1 year time, it will become a 2-year paper. And because yield curve is very steep, so you get a roll down benefit because effective interest rate for you have gone down. So one thing to note is that first is that yield curve currently are extraordinarily steep. So if you are at least to the about 4 or 5 year point, both in the GSEC curve and SGL curve and also in the corporate bond curve. So if you are, depending on your horizon of investing, if you are suitably placed in the yield curve in a somewhat quasi-passive way and let the yield curve roll down and roll down the yield curve and get benefit out of that, you will still get a decent return. We have been advocating this strategy since last 1 year. And in a scenario, if you compare, in the last 1 year, 10-year GSEC went up from 580 to 680. Repo rate was extremely low, but even in that scenario, all these roll down strategies have given pretty decent return, 6% plus return. So a lot of decent return you have got despite this rising yields because of these benefits. That's point number one. And point number two, more importantly, is that, as I just discussed, the actual return that you get in fixed income is a function of not what is there, what is going to be the rate hike cycle, rate cut cycle, but what all is already factored in the prices. So, markets are like discounting machines. If markets have already discounted that there's going to be a rate hike cycle, and rate hike cycle turns out to be lesser than what markets have discounted, you will still do much better than you are sitting in cash. And because markets are already factoring in 200 basis point rate hike, if you look at the swap curve over the next 1 year, and most likely are they not going to hike that much. So in most scenarios, you can play with. I think fixed income still make a lot of sense to invest.
Sure, makes sense. Sunaina, the conversation is not going to be complete before knowing what your tilt towards the market is. What are the sectors that you think are going to outperform, and which are the ones you think are going to underperform from here?
So, I think, as I was discussing earlier, credit health in India is doing extremely well. We're probably best placed. And when I'm saying credit health now, I'm talking about the organized players, the ones where, investment grade, where mutual funds would actually invest. So across the board, actually, from a health perspective or an underwriting perspective, you're spoiled for choice. A lot of sectors doing extremely well. I would be a little cautious about sectors which are more contact oriented because you never know when there is another resurgence of a COVID wave, etc. And also the bottom of the pyramid of both the household balance sheet as well as the corporate balance sheet. So that's where you would be a little careful. However, you don't expect any nasty surprise from that either, because, all the NBFCs which cater to those segments are extremely well capitalized and leverage is low. So, there are a lot of good companies and good sectors to go there and pick from. The challenge, of course, remains on corporate bond spreads. The AAA spreads, AA spreads, single A spreads are at all-time lows. And, that's where the challenge still remains.
Yeah, absolutely. Bhupesh, as well as... Right. Bhupesh, Sunaina, both of you, thank you so much for taking the time out and speaking with us. I can already see our next panelist waiting by. Sumit, over to you.
Thank you, Aisha, Sunaina, and Bhupesh for that. Quite an interesting panel, and we got quite a lot of views on fixed income, which was really, really helpful. So thank you for that. For our audience, the rating feedback pop-up must have come up, so please do leave your ratings for the session. Before we move on to the next panel, though, I have a very interesting poll coming up. All you need to do is you need to click on the answer. And before I come to the question, just a reminder, please do share your thoughts and your suggestions. Let us know your views. Use the hashtag Voyage2022 and do remember to tag us at @ABSLMF. All right, here's the poll question before we head into our next panel. Are you seeing more conversations with clients about cryptocurrency investments? Option A, yes. Option B, no. So are you seeing more conversations with clients about cryptocurrency investments? Obviously, there's a lot of talk about cryptocurrency in media. We're covering it a lot. Of course, the government has been making different announcements about that. RBI is talking about that. So what's happening on the ground with you guys? For our audience, what are people coming to you? What are your clients coming to you and talking? Are they or are they not? So this must have been the time you must have put in your answers. I'll get you the poll results after this next panel. So now let's move on. Let's move on to our next panel. Now, besides having a finger on the overall pulse of the economy, it is important to keep a tab on some of the important sectors as well. And that's where our next session comes in. This is titled Islands of Opportunities, Key Sectors with Growth Potential. And we'll see the speakers share their insights on some of the sectors that show the most amount of opportunity. Aisha Faridi from ET Now will step in as moderator, and she'll be in conversation with senior analysts and fund managers equity at Aditya Birla Sun Life AMC Limited. She's in conversation with Chanchal Khandelwal, Jonas Bhutta, Nitesh Jain, and Dhaval Shah. Over to you guys.
Hi, good evening, all of you. Today we are here to talk about islands of opportunity, the key sectors with growth potential. Now, when we talk about growth potential at the onset, I must tell you that the AMC is particularly bullish in sectors like infrastructure, like real estate, consumer durables. And basis that, over the next half an hour, 45 minutes, we're going to maneuver our conversation. I have with me joining in right now Nitesh Jain, Jonas Gupta, Chanchal Khandelwal, as well as Dhaval Shah. Gentlemen, hi, good evening. Good to have all of you on board. Dhaval, let me start off with you, considering you are tracking, if I can call it, the most fragile sector right now, consumer durables. Largely the input cost pressures, the entire inflation around us, everything from crude or fuel rather, to just everything that we're consuming right now is just getting so expensive. And that's the first port of call where consumers are going to get a little price conscious when it comes to consumer durables. What, according to you, Dhaval, then are going to be the key demand trends that you decipher in this post-COVID world? Or do you think the consumer is going to continue buying back with a vengeance and not take a look at their pocket?
Sure. So, let's look at demand in the post-COVID era over the last 2 years, how things have actually panned out. And the first thing that you would see that, post the opening of lockdown, many people were positively surprised with the kind of, the demand uptick which was there, or the pent-up demand which was there, across the consumer durable sector. And largely, people looked at the reasons to see that why is that happening. And we figured out that there was a lot of reverse migration of labor from urban areas to rural areas. There was urban consumer who wanted to buy things like, microwave ovens or dishwashers where sales went up 3x, 4x, largely to make their lives more comfortable in the absence of any other help that you're trying to look at when there was a lockdown. And it was a euphoric year of FY21 where, there was a big delta change in demand that you were trying to look at. Over the last 9 to 12 months, as you rightly pointed out, because of inflationary pressures, there is a dichotomy here when we look at demand, numbers in an overall sense, that whatever is related to the mass segment is witnessing, lower volumes. In many cases, volumes are lower by 8 to 10% on a YOY basis, or even a, 2-year CAGR basis, slightly negative on an overall volume basis that we're trying to look at from mass segment, which is where the pinch has been the much harder because of inflationary expectations. But premium segment continues to do well. So any company which is geared towards premium segments continues to see very robust numbers. They are not only being able to, pass out the whole of inflation which has been there, plus there has been a decent volume growth, which is there on the premium segment. So that is the near-term outlook that has been there on the overall demand side, and we would continue to think that will continue over the next 12 months also. But more importantly, we should not lose sight of penetration levels in many of these sub-segments. Like, look at refrigerators, we are actually as in India having a penetration of around 33%. So 1 in 3 homes actually own refrigerators today. Our washing machine is at 15%, and room AC is only at 7 and 8%. So that does say that there is a long runway of improving penetration levels ahead of us over the next decade that we're trying to look at, which makes this whole consumer durables investment a great hypothesis. What are the levers where this improving penetration can typically happen? First one clearly is that globally we have seen that as your per capita GDP improves, you invariably find because of the improving per capita GDP, you find that there is an increase in the consumer durables offtake. Second is access to electricity, and that is where India has covered a lot of ground over the last 5 to 7 years. Particularly if you were to look at the north and eastern part of India. Over the last 5 years, there has been a sharp improvement in not only the availability, but also the quality of electricity which is available there, and which is leading to improving penetration in a lot of small ticket consumer appliances like kitchen appliances, mixer, ovens, and etc., as well as large appliances that we're trying to look at. So I would say, yes, the next 12 months looks a bit challenging for the mass segment. But at the same time, given the low penetration levels, this looks like a good structural story from a next 5 to 10 year perspective that we should be looking at from this segment.
Sure. Nitish, at the other end of the spectrum is the sector that you track, infrastructure and cement. What kind of opportunities do you think lie for the infrastructure sector in India? And what kind of reforms do you think the government has undertaken as we come out of COVID to try and help the sector in the recent times? And, similarly, in some sense, just about every sector is getting marred with input cost pressures, and the same goes for cement as well.
So basically, the key enablers for the infrastructure in the country are basically two factors, right? One is the interest rate, and the other one, the important one, is the government finances. Now, if you take a historical backdrop, clearly these two factors right now are quite supportive. We would have seen the GST collection number, monthly numbers, or the advanced tax collection revenue numbers of the government. And also the interest rate in the country compared to the historical trend are quite low. So my sense is that these are conducive for a long-term infrastructure build-up. Our country a lot has to be done in the future. And in this backdrop, if you look at the government of India, a couple of years back, they have come out with the NIP, the National Infrastructure Pipeline, wherein they have put across nearly $100 trillion worth of outlay over the next 5-year period. So I would say there are it's a very broad sector or broad space to look at. But clearly, two things which stand out, which are also critical from a capital market point of view, which gives the investable opportunities as well, are highways and the water-related infrastructure. So, two schemes which are part of the NIP. One is the Bharatmala project phase 1 and phase 2, wherein the government has said they will build nearly 70,000 kilometers of highways. Out of the 70,000 phase 1, phase 2, 18,000 kilometers have already been awarded and are under implementation. And second big opportunity which I can see on the water side, wherein they've committed that in next 5 years, each and every household in India will have a potable drinking water. And these two things, we have actually seen implementation on the ground. The listed companies in India, they have started getting orders. Implementation is already in place. So all in all, it's quite positive. And one more thing is, it's quite domestic sector, right? No matter what happens globally, I think the infra spending will continue in India. As far as the input costs are concerned, you're right that steel and cement prices have gone up, which are nearly 50% of by and large any construction thing. So there could be some impact on the projects, but looks like they will cool off once this entire global things get subside. So that's on the infra. On your point on cement, you're right that historically in India, particularly large investors have always played infra space through cement routes by investing in cement companies. Because the reason is, if you look at cement as a sector, 15 years back, cement was around 150 million ton of capacity. Today, it is 500 million tons of capacity. And even if today you add the balance sheet of all cement companies, you will find hardly any borrowings on their balance sheet. At the same time, I would say we haven't seen any large equity dilutions or equity raise or IPOs or private equity. So this 150 to 500 figure, they have simply reached by investing their own cash flow, which itself is a big positive. It says that the inherent cash flow generating capacity of cement industry is huge. Therefore, it has always remained a darling of investors. But I would believe there are opportunities in the pure infra space also, because today, if you look at, we can hardly count any infra company which is more than $1 billion market cap. So I believe that in the next 5 years, I think many more can be built up there.
Sure. Jonas, if Nitesh is that bullish on infrastructure as a sector, I bet you think industrials are going to do very good in the next 2 to 3 years, wouldn't you?
Yeah, absolutely. So picking up from where sort of Nitesh left, so there are a couple of other things that sort of are driving demand for industrial. So some of them are largely globally induced, things like China Plus One, which is more a post-COVID realization by global companies looking to reevaluate their supply chains, and which is where sort of India fits into the picture. The other is, again, global countries sort of incrementally becoming more uncompetitive in the overall scheme of things and are looking at other avenues to produce products from. So these are two global trends that we are seeing that are benefiting a lot of industrial names. But there are a host of other domestic themes that are seeming to be playing out for the engineering sector. First is the organized move, so move from the unorganized sector to organized sectors. The second is the localization. So, post-COVID, we've had a localization drive, say, for instance, in the defense sector. In fact, even today, the government announced a new list of products that will be locally manufactured. The third is the PLI schemes. Again, something that was launched a couple of years back, where the government envisages roughly 2.5 lakh crores kind of investment incentive, which will lead to a 4 lakh crore kind of investment by the beneficiaries, and could potentially drive a 10 lakh crore kind of value addition to the overall scheme of things. And last but not the least is a host of sectors that were on a capex holiday for the last 5-6 years are looking to come back, at least for the next couple of years, in terms of capacity addition. So that is the cyclical bit. The former 4-5 trends seem to be slightly more structural in nature. But overall, over the next 2 to 3 years, I would believe that all of these things put together would lead to better times for the industrial sector.
Sanchal, where lies real estate? Because, real estate, the sector that you track closely, is coming out of a decadal bear market, right? We can see that reflected on the stock prices. But, the underlying theme remains same. Real estate needs cement, real estate needs steel, real estate needs labor costs, and all of them have seen a big spike in inflation. At the same time, the big question really is whether demand is really that strong that, realty guys can actually up prices and that will get absorbed. Or do you think they'll end up hurting margins at some point or the other?
Thanks, Aisa. If I look at real estate as a sector, and if I take a step back, if you see 2016-17 is the first time when the reform started. RERA was the biggest reform. What RERA did was that from companies who were taking out cash from the unit level of the project and taking it at the company level and funging the cash flow, that was disallowed. That means that the project money at the project level has to be used. Then ILFS crisis happened, which further reduced the cash flow in the sector, and then you had DMON and GST. All this made sure that the tightening of the sector, the cash flow or the fund requirement of the sector was tightened. And that was the reason the sector itself went through a big correction. Now, if I look at from a COVID world, post-COVID, all of us realize the importance of home, not just owning a home, but owning a better and a bigger home, right? So from that perspective, 2021, as I tell it, it was a start of a real estate cycle. It was like a Goldilocks situation when the interest rate was at an all-time low. COVID made people realize the importance of home. The consolidation in the sector, which started was happening, and the inventory in the system was almost at 4.5-5 years. There's 10 lakh houses which were not sold. In fact, in 2021, the absorption was higher than the launches for the first time in the decade. And normally the cycle starts when the absorption is higher than the launches. And today the inventory is almost at 2.5 or less than 2.5 years. And I think this cycle which has started will continue for some time. And the reason of belief is that, IT as a sector has come back and the kind of salary increase in this sector which has seen is almost is high. And we think this IT boom will continue. The other thing, if I look at the Naukri job index is almost at a peak. And I think that Kunal and Jonas and Nitesh pointed out that the revival in the industrial, that is creating job in the market. So demand from that job creation is happening. The industry has consolidated, and that's where the cycle will revive. As far as price increase, which you highlighted, the cement and steel price increases, in last 1 or 2 years, developers have not taken any price increase. For the first time in last quarter, they've taken a price increase of 5 to 6%. And this price increase of 5 to 6% is in line with the increase in the price of the raw material. They are not like the last cycle when we saw developers increasing prices 5%, in fact, every quarter. This time they have not taken price increase. There is a lot of cushion in the price increase which can happen going forward. And so margins from that perspective will be protected.
Absolutely. Though there is one caveat to that, Chanchal, considering COVID is over and all of us are back to offices, we needed bigger homes, but 2 years back, not anymore. I think life is back to normal and how. But anyway.
I got deeper answer there. We have realized the importance of a bigger home, and that thought process will remain. Whenever you go back, you'll always realize that more than 50% of your 60% of your life you spend in your home. So you will tend to look to own bigger and better home.
Yeah, I guess so. But Nitish, just to take that point forward, the thing when you look at infrastructure companies from an investment angle, is that infra companies historically haven't made you money. Yes, there has been one L&T, but it's for everyone to know who is an L&T investor, what the stock price record has been in the past. What is the reason for the same? I mean, why do infra stocks not make money like any other? And is there any better way you think, perhaps, tactically position yourself in such a way, or, some large opportunity size that one can look at, that the sector does represent, to try and capture the investment angle a little bit better and make more money from the sector?
Yeah. So Aisha, you are right. Absolutely. I mean, in the past 20 years, despite this, huge opportunity which has been there, purely from an equity market point of view, the investor did not make any great money in, Indian infra company, barring say, a couple of names. I would say there were 3-4 problems. First of all, the infra development model in our country was evolving. Okay, earlier it started with EPC, then it went on to asset ownership through BOT, and then lastly it came the HAM, the hybrid annuity project, where the government is guaranteeing certain sort of annuity. So the model itself was evolving, and companies were targeting revenue or ordering in that revolving model. Number two was interest rates were very high, particularly the risk weightage for infra companies has always been very high with banks. So the effective interest rate that they pay is much higher than the system-wide interest rate. So that was another problem. Thirdly, if you look at the history of Indian companies, infra company, I would say the capital allocation was also a problem in individual, companies, wherein they went for unwarranted diversification. They went into real estate, buying some large land parcel from the cash flow and things like that. So all this culminated into a scenario wherein the equity returns were depressed. I would say going ahead, there has been a big learning curve which the industry has undergone in last 15 years. People now understand what is the importance of capital allocation, how you maintain the balance sheet, how you maintain the cash flow, and the investor feedback mechanism has also been quite robust to these companies in the past. So I would believe now going ahead, I think those same mistakes can't be repeated. And therefore, and one more thing is today the ministry, if you look at the Ministry of Transport North, they are very pragmatic and very practical. So for example, in COVID, when the toll revenues were very low, or the developers were facing problems with the cash flow, they came out with a whole list of, ease out policies. So they are very, very pragmatic now, which was not the case maybe say 10 years back. So all this, scenario, I would believe, I think that old phenomena of not making money in infra companies should change. And as I told you in the earlier question, cement cannot remain the only way to play the infra theme. And we will see that some more companies coming up if they maintain the balance sheet and the capital allocation.
Sure. If ITC can do it, I'm sure infra also can. But Jonas, if I could come to you over here, considering one has seen that industrials as a space is a very large umbrella, purely from an investment angle, tell me what are the new sectors that can contribute, you think, or further in, extend the industrial capex cycle 2 to 3 years hence? What are the newer avenues that that an investor can look at beyond the obvious names?
Sure. So, typically industrial cycles globally, last by about 4-5 years. And even in India, we saw that happen between 2004 running up to 2010-11, where there was massive capacity creation across metals, hydrocarbons, roads, etc. This time around, we are sitting on a decent capacity in those, so-called legacy or old economy sectors. However, there are a couple of other sectors that may come up and drive the cycle longer this time around, and some of them are to do with the new age sunrise sectors. So, be it battery related technology that may come in with the advent of EVs, a host of equipment that goes into battery tech, as we call it, would be one avenue. The other is to do with semiconductors. So, incrementally what we've seen with COVID is a scramble for chips, and there are only a handful of companies or countries that sort of have these manufacturing capabilities, and India wants to sort of develop them ground up. And once that happens, there are a host of, again, engineering components that go into semiconductors. And the third and the last one is hydrogen ecosystem. So the world over, we are looking at decarbonization, and hydrogen is looked as probably the most plausible answer to decarbonization. Again, here we are seeing a lot of activity. In fact, the country sort of announced a draft hydrogen policy a couple of months back, and that will be carried forward. And here again, this is something that will help revive the power sector. When I say power sector, it's not the coal sector, but this will drive demand for renewables. So for instance, a 1 million ton of hydrogen would require 20 gigawatt of power, which will be largely renewable. So, this is likely to sort of play out over a 5-6 year period. And hence, if the current cycle was to continue and, wean off just about the time when these three avenues start picking up, and which is when hopefully we'll have a longer cycle.
Sure. Okay. Before I take my next set of questions, we have tons of viewer questions coming in. So let me try and squeeze in a few. Ramchandra Prasad wants to know which 4 sectors will emerge as the best sector on the basis of return as per recent data. And we have a gentleman called Kangaroo. I'm sure that's his ID, and a very interesting name at that, Mr. Kangaroo. But which sector you feel is one where one can invest aggressively for the next 2 to 3 years in equity? Chanchal, you want to take that one? The sectors to bet on for the next 2 to 3 years?
I think from a 2 to 3 year view, as we as a house are very bullish on industrial cycle revival. So industrial is one sector to bet on. We as a house are also very bullish on banking as a sector. So that's the second sector one can look to bet on. And from a long-term structural view, we believe that consumer discretionary, the under-penetration is very high. So that's the third sector. If I were to recall top 3 sectors, I would look to bet from a 3 to 4 year view.
Sure. Hari Krishnan Raghu has said, what's the analyst's view on PSU banks? Which one of you would want to take that question?
Okay, so I'll possibly attempt that one, right?
Sure.
So, our view on the overall PSU banks is that, many people get typically lured by, very cheap valuations in that space, where most of the PSU banks are actually quoting at below book value. But more important parameter to actually look at is that, how is the asset quality of many of these banks in an overall context of, where we are across cycles. And that is where we don't find that many of these PSU banks, are able to sustain, good quality books over the last, if I were to say even 2 decades. And there are, only few select ones where, they have been able to add overall book value on a consistent basis that we're trying to look at. So we would be fairly more optimistic on private sector banks willing to pay a premium to their book values and see that they compound over a period of time, and have a very selective approach to large PSU banks where we find that still there is a very reasonable growth runway ahead of us, and be very selective in that space in the overall context.
Sure, Dhaval, thank you so much for that, and I hope, Mr. Krishnan, we were able to answer your question on PSU banks. But Chanchal, we just have a little time left. I can already see Timothy Moore has already logged in. Chanchal, when one talks about real estate, I think the question is not here of demand, of people realizing that they need bigger houses, and I'm sure, real estate companies will manage to pass on, considering, it's a very calibrated price hike that they are undertaking as of now, and I'm sure that, the price hikes are going to get absorbed. But purely for real estate companies, considering their dark past, do you think capital efficiency under the new regime is something that they'll manage to maneuver through? Chanchal?
Hi, can you hear me?
Yes, I can hear you. Go ahead.
Yeah. So if you look at capital efficiency, what has changed in this sector is that REIT has come up in this sector. That means that in the past regime, a real estate developer used to do a commercial, mall and residential all at the same balance sheet. But today, with the REIT allowed, companies normally divest the entire commercial and retail separately. So that allows them to get the funding. So that's the first big change which has happened. Second thing, if you look at from capital efficiency, most of the developers are not focusing on getting the land bank. The past regime was about land bank and land bank and land bank. This regime is about efficiency. The faster you're able to churn. To give you some number, Aisha, India today, there are no developers doing more than 10 million square foot. And India, top 10 developers would be 15% of the real estate market. China, it's a 38% is top 10 developers. In China, there are at least 5-6 developers doing 30 to 50 million square foot. The same number for a developed market is 78%. 78% of the market is owned by top 10 developers. So the cycle has just started. This number used to be 5-6% almost 3-4 years back when the consolidation happened. Today we have reached to 15%. And I'm sure in this journey, the top 10 developers will command a bigger share. Right. They'll go for a joint venture or joint development, which is asset-light model.
Sure. Okay, great, guys. Thank you so much for speaking with us and discussing all the islands of opportunities that equity investors can look at. Chanchal, Jonas, Nitesh, Dhaval, all of you have a great evening.
Thank you very much. Thanks for having me.
Thank you. Thanks.
Sumit, with that, it's back to you.
Thank you, Aisha, for that. And thank you, Chanchal, Dhaval, Jonas, and Nitesh. Quite an interesting conversation, very insightful. It was great to get these perspectives of the different sectors. And we're always looking for better opportunities for investments. Ladies and gentlemen, before we went into this panel, I asked you one very important question. It was a poll question. Before that, the ratings pop-up must have come, so please put in your ratings for this session. I had asked you the question, are you seeing more conversations with clients about cryptocurrency? Well, it's not exactly half. The majority says 58% are saying yes. 58% are saying that they are having conversations with their clients about investments in cryptocurrency. Well, that's quite interesting. I would love to know what these clients are asking you and what you're telling them, but you can leave that in the comments for sure. But without further ado, let's start on with our next session. Do remember to keep sending in your thoughts and suggestions. Use the hashtag Voyage2022. Remember to tag us at ABSLMF. You know there are a couple of quizzes going on here today, and if you want to win, please keep reaching out to us. Share your thoughts, your comments, your questions with us. All right, now this next speaker is one that I've been eagerly waiting to listen to. He's a well-known name in the Indian and global financial services space. He's an expert in emerging market economies. Now, as the pandemic fades, the scope of growth in emerging economies is very huge. And so he will be sharing an emerging markets outlook with a global perspective. Please welcome the co-head Asian Economics Strategy and Commodity Research at Goldman Sachs, Mr. Timothy Moore. He'll be taking us through his presentation, followed by a chat with ET Now's managing editor, Nikunj Dalmia. So stay tuned for the next session, which is coming right up.
Well, good afternoon, everyone, and it's a great pleasure to be able to present our views on the global equity markets and focusing on Asia, and then ultimately giving our views on India as well. I will take about 25, 30 minutes to go quickly through the presentation we have, and then I will welcome the Q&A that we'll have and the conversation afterward. So without further ado, let me go, first of all, just give us a quick snapshot of what we're thinking about global asset markets. And the key points here are that we continue to prefer equities among the various global asset classes. We're optimistic there, although expecting moderate levels of returns for reasons I will articulate in a moment. We're very positive on commodities. We've had a very strong view about commodities being in a super cycle, and I think we are well above consensus there. We also, somewhat interestingly, are overweight cash for the time being, given the complexities of the global investment environment and some of the risks therein. Our chief funding area would be in government bonds, because with the change in the monetary cycle, we think that bonds which have been giving negative returns this year will continue to be under pressure. So certainly for the developed market complex where rates are rising, we think that bonds are not a good place to be, and so they are a principal funding area. And they were also underweight credit, thinking that credit spreads are tight and probably need to widen out somewhat, and we don't see particularly attractive returns there. So the bottom line here is overweight equities and commodities, and underweight generally most aspects of fixed income. In terms of returns, a lot of numbers on the page, but the real key to focus on is that we're looking for sort of moderate, kind of low teens upside to our various benchmarks. We're a bit more optimistic on Asia. But the broad complexion of things is that we're looking for an environment where we have moderate, sort of high single-digit earnings growth, in some cases some valuation recovery, a little bit more pressure on the United States, which I'll get into a little bit later, but that's broadly the configuration of our views for the global equity market class. Drilling into this a bit more, this chart shows the valuations for the key regions globally, the US on the left, then developed Europe, Japan, and then Asia ex-Japan. I think the key point from this chart is that the US does stand out as being more richly valued in both absolute and in terms and relative to its range, whereas the other areas, particularly Europe and Japan, are at the low end of their respective ranges. So broadly speaking, you look at sort of 18 times forward earnings for the US and sort of 12 to 13 times for the other markets. And that is one of the underpinnings for our view currently to be tilted somewhat away from the United States. Not that we're bearish on the U.S., just with the recovery we've had, we don't have that much upside to David Costa and my U.S. strategy colleagues' target of 4,700 for the S&P 500. Now, if I could step back a little bit before going to the topical issues of the day, I want to highlight for everyone a broader view here, which I think is quite helpful, because oftentimes we get lost in the day-to-day minutia or the high frequency news flow. And it's very important as investors for us to step back and look at the bigger picture. So this is from my global strategy colleague, Peter Oppenheimer. And what we note here is that really over the past century, there have been three very long, what we call super cycles since the Second World War, which have been, of course, very favorable for overall investors. And those have been punctuated by what we call fat and flat environments, which are basically where you've got a wide trading range where on balance the market doesn't make that much progress, but there's a lot of volatility. We think we're entering one of those now. I'll go into a little bit more of that and what you do with that in a moment. So it is a somewhat more challenging investment environment, but there still is plenty of opportunity in there. You just have to approach it in a slightly different manner. Now, part of the reason why we think we're transiting into this fat and flat environment is that interest rate cycle is turning. And this is a very interesting chart for the Bank of England, which goes back 700 years. I would challenge you to find charts that go farther back in time than this. But going back literally to 1300 in England, we can see what interest rates were. And as you can tell from this, obviously there's been lots of sort of spikes and troughs. But the overall trend has been to lower interest rates. And of course, most recently with quantitative easing, we've had interest rates being close to zero. So we think that is changing now, and particularly if you zoom into the right side of the chart, we can see that this very powerful, nearly 30-year bull market, which started in the early 1980s, we think that's ending and that we're going into a period of higher rates. We don't think they're going up as much as we have seen on this chart, but certainly interest rates are going to be a different environment than the one that we've been enjoying for the past 30 years, and we need to take account of that in terms of our investment views. Now, zooming a little bit more into the current issues, of course, inflation is a growing, clear and present danger. I'll talk more about that in a moment, but clearly inflation is a concern for equity market participants, particularly because we've had this spike in commodity prices. And what we note here is that typically higher inflation tends to put pressure on corporate profit margins, which is something that should be of concern to investors. And this is one of the things which has been promoting a shift from the leadership of the growth style in the market to more of a value style. I mean, growth, when rates are low, growth tends to be favored because growth is what's technically called a long duration asset. It's where people look out into the future and anticipate all the potential growth that could take place. And since interest rates are low, they value that future growth more highly. When rates start to rise, then growth tends to come under pressure, and the value part of the market tends to do a bit better. This is something we've been writing about for about a year. I think there still is further to go in that. But that being said, we would note that the technology stock fundamentals are actually still quite strong. So we think it would be incorrect to be getting significantly bearish on technology, simply because, as this chart shows, the profitability and the earnings of the tech companies have significantly outstripped those of the rest of the world. Here on this chart, for those who can't see it, this is the darker blue line is the overall profitability of the global tech complex, and that's significantly outstripped that of the other parts of the market. And if we drill further into this and we look at the valuation of tech at previous peaks of the tech cycle, which goes back to the tech bubble in the United States in the late 1990s, and earlier than that, the Nifty 50, which is the origin of the, I guess, of the Indian headline index. The Nifty 50 was, of course, in the 1960s, and what we see here from this chart is that valuations for tech stocks at those peaks were much higher than they are right now. Today, we're talking about 25 times earnings for the larger mega cap stocks, whereas we're talking about nearly 40 to 55 times earnings in previous instances. So we're less concerned about overvaluation, especially given the higher degree of profitability. But where this all leads us, and this is one of our key longer-term strategic views, is that we think in the changing world that I've very, very quickly summarized, that we need to be looking at different ways of generating alpha, of generating excess return in an environment where the beta, the overall directional return, may not be as pronounced. And we've created this acronym called IDEA, which stands for Innovators, Disruptors, Adapters, and Enablers. I don't have time in this presentation to go into all the details, but these are various facets of the development of technology and the way that companies are likely to be benefiting from this. And what we note here in this chart is those groups of stocks I just quickly summarized have attractive combinations of expected sales growth along with reasonable valuation. So this would be one of the key longer-term themes that we would like to highlight to you. Now, turning to the more topical issues at hand, of course, we've had a spike in geopolitical risk. This is a longer-term global geopolitical risk index, which, of course, has increased quite significantly as a consequence of the Russian invasion of Ukraine. Now, what we find here is that risk appetite, which is on the dark blue line here, plummeted as we had a significant sell-off in markets. That's since recovered somewhat, but markets are still on a somewhat more tender footing, if you would, given the complexities of the geopolitical environment globally. Now, turning to Asia specifically, what we find is that in periods of geopolitical risk spikes, you tend to have difficult performance, obviously in the month when it's happening, but also in the next sort of 1 to 3 months. But on a 6 to 12 month view, the shock from that risk tends to fade, and you tend to get some recovery in markets, as you can see here from the right side of the chart. More broadly, when we have a 10% or greater correction in global equity markets, which we did have, when just immediately after the invasion of Ukraine, the global equity markets tipped down into a sort of a 10% correction. And what we find here, again, is that even when you have a broader sell-off in global markets, that on a 6 to 12 month view, you tend to recover from those sold down positions, even as the darker blue bars here show, if you subsequently have a U.S. recession, which is obviously one of the issues that investors are currently concerned about. So really the point here is that there may be sort of tougher sailing in the next 1 or 2 quarters, but if one's patient, then the better fundamentals start to come through, especially from a sold down position, and you tend to get attractive returns, especially compared to what we think will be losses in fixed income. So this again underpins our constructive view on equities. Now let's zoom into some of the immediate issues at hand. And of course, higher oil prices and the broader increase in commodity prices is super topical. So we're having what we call a supply side driven oil price shock. And the reason why that's important is that if oil prices rise because growth is better, because demand is better, typically equities can do quite well. But if they rise because of supply side constraints, then you get sort of all the bad aspects of higher commodity costs without any of the offsetting benefits of better growth. And as you can see from this chart here, we think that oil prices will still stay high for the next 2 years, even net of the release of reserves by the United States from their petroleum reserve. We think that oil prices will be about $125 a barrel for the rest of this year and $115 a barrel for next. So we're in a period of high oil prices, and of course, from an Indian perspective, that's consequential given India's reliance on external oil imports. Now, the effect of a supply-side oil shock on commodity prices specifically, but also more broadly on growth, of course, has what you might call stagflationary consequences. Generally, it will lead to lower growth levels to varying magnitudes, as we show on this chart, and higher inflation. And a way to contextualize this is to see how our Goldman Sachs global projections of economic growth and inflation have shifted just in the course of the past month or two since this oil price shock and the invasion of Ukraine. The way to understand this chart is that the lighter blue diamonds are what we were expecting for growth and inflation at the beginning of this year, or just even sort of a month or two ago, and the darker blue diamonds are where we stand now. And pretty much everything is shifted up and to the left, which shows that you've got less favorable or more stagflationary combinations of lower growth and higher rates. So why is this important? It's because the market returns in Asia tend to be much worse when you have a stagflationary environment. What we see on the left side here is that your average quarterly return for the regional index is about 1% to 2%. So if you just didn't have any expectations at all, your sort of forecast for quarterly returns would be up 1% to 2%. But when we have inflation above long-term trend, that tends to come down to about flat. And when you've got growth below long-term trend, you tend to have sort of down 1 or a bit more in terms of returns. But when you have the combination of higher inflation and lower growth, then you get on average about -6% on a quarterly basis. So this is why this environment of what we call quasi-stagflation, which is below trend growth and above trend inflation, is of significant concern to investors. And if you look at the right side of the chart, the reason for that is that you tend to have significant reductions in earnings growth during that time. Now, turning to another issue that markets are contending with, not only is growth under pressure and inflation rising, but interest rates are also rising. And I'm sure everyone knows that the Fed has turned much more hawkish. Expectations for the market and for our Goldman Sachs economists have significantly increased. this chart shows how we're likely to be engaged in a fairly significant tightening cycle by the Fed. And complementing that, at the longer end of the curve, we see a significant increase in U.S. 10-year yields. We've had more than a 60 basis point rise in just the last month in terms of U.S. 10-year yields, and we're expecting them to rise moderately further from here. Now, this is of consequence because in an environment where inflation rises, which of course would also engender higher interest rates, you tend to get significantly different performance by a whole raft of asset classes. So this is a bit of a complicated chart. I won't go into the details, but just the way to look at it is that the blue bars show how the assets perform when inflation is high and rising, and the orange bars show what happens when inflation is falling. And you can see there's quite a significant difference between how different assets, whether it's oil all the way on the left, or, for example, the U.S. dollar or U.S. 10-year yields on the right, there's a significant difference in terms of how all these different global asset classes perform depending upon the inflation environment. And what we see here is that there's also pressure in terms of how the market leadership is likely to change in the coming years. So this is an interesting chart which shows on the left side, to the left of this vertical bar that we've shown, how a variety of asset classes in the world have performed since the start of quantitative easing in 2009. And you can see all the way at the left that NASDAQ was up nearly 10 times, huge return, S&P up over 5 times, etc. So asset markets did very, very well. On the other hand, on the right side of this chart, this is real economy prices. So whether it's nominal GDP, wages, inflation, etc., and of course, their return has been very low. So really what the point of this chart is that during a period of quantitative easing, we've seen terrific performance and returns from assets. However, this chart from the 1970s shows that the leadership really changes in a higher inflationary environment. Gold has done well, commodities do well, but you don't have as good returns from other markets, and the real economy tends to do somewhat better. So this is an important shift in terms of the overall configuration of the global macro environment. And to really emphasize this point here, what we see here is that in an environment where growth is falling as proxied by the ISM index in the United States, and either inflation is rising, which is this topic of the left part of this chart, or the Fed is tightening, which is the right side. If you look at this second to right series of bars, the average return for the S&P 500 tends to be most constrained during that environment. So this is why this kind of transition to a fat and flat range is a challenge. But the important point here to note is how do equities compare to bonds from an asset allocation perspective? And even with those challenges to the equity market, we find that the earnings yield compared to the yield you still have on bonds, which is still quite low, is still at a premium, a significant premium. So really what this suggests is, the acronym TINA, there is no alternative, that in a world where the overall expected returns are lower and it's a more challenging environment, equities still look to be one of the better places to be, and that also underpins our preference for equities compared to bonds. Now, within the equity complex, as this chart shows, this is the relative pricing of Europe, Japan, and Asia ex-Japan, and EM more broadly versus the U.S. And pretty much every one of these non-U.S. Asset complexes is at a discount to the S&P, and that reinforces the point I was making earlier, which is also reinforces our preference for parts of the world which are outside the United States. Now, just very quickly on the U.S., we think earnings will continue to rise at a moderate pace. We have a 4,700 target for the S&P. With the recovery that we've had in the U.S. index, we don't have terribly much upside to that. Even with the sell-off last night, we only have sort of 3-4% upside to the S&P. We've got more elsewhere. So this again underpins our preference for non-U.S. Markets. Within the S&P, however, we would note that the potential return is going to be significantly different depending upon whether the U.S. tips into recession or not. There's lots of questions we're getting from clients now about the risk of U.S. recession, which we quantify at about 30-35% based on current circumstances. If we don't have a recession, then as the blue line shows, we can probably recover. If we do have a recession, then there's probably some more downside. So this is a key issue to watch going forward. Within the U.S., for reference, we like infotech, energy, and healthcare. We're less keen on various parts of the defensives as well as the autos and component space. Now, turning to Asia, and this is where I'm going to focus my conversation in the last third of my presentation. This is a little bit complicated chart, but it really encompasses three very interesting dynamics. The first is that on the bottom axis, we are calibrating the relative performance of the various markets and sectors in the region under stagflation conditions and also under rising interest rates. Because as I've been saying, these are the sort of the clear and present challenges to markets. And on the vertical axis, what we're doing here is evaluating how the degree to which markets have priced the changes in the macro environment. So anything that's low, the lower down you are on this chart, the better it is, because it means that markets have already priced in a lot of bad news. So as you can see from the red highlighted part in the lower right section of the chart, there's a variety of markets and sectors that they would include things like China, Taiwan, Singapore from a market perspective, and they would include things like the metals and mining sector, the banks, real estate, and some of the deeper cyclicals, which we think are the more attractive parts of the region to be in. I will note that over here, where if you can see my cursor, India is in a less favorable part of the market because it's actually done better than one would expect given the change in the macro variables, and it tends to be somewhat more vulnerable to stagflationary concerns. So this underpins, as I'll elaborate in just a moment, why we moderated our view on India a few months ago. We had been overweight all of last year, and as I'm sure everyone knows, India was the best performing market in the region. We moderated back down to market weight and feel that we love the longer term view on India, but feel that the market valuations are somewhat expensive, and that's why we think India is likely to be in somewhat of a trading range. And we think that for the next sort of two quarters, we'd prefer to have a market weight stance than an overweight stance. Now, just in terms of valuation, here this shows that valuations have compressed below what we think is fair value, even allowing for a bit more conservative share price target, given all the macro concerns I've been indicating. And if we pull all our views together here, what we can see is that we're expecting kind of low teens overall upside for the region. We're overweight places like China, Taiwan, and Singapore, as I mentioned. We're market weight on India, which I'll get to in just a moment. We have a kind of a variety of different parts of the region that we like, whether it's the tech, hardware, and semis, kind of on the growth side of things, or liking banks, and in particular energy and metals and mining in the sort of the value and the commodity and interest rate sensitive space. We have a number of themes here, many of which we think are also relevant within the India market specifically, which would include beneficiaries of cost inflation, which would be companies with high and stable margins. We like the beneficiaries of higher rates, which would be the banks. We think you want to be careful about the risk of stagflation, so we've created baskets of stagflation winners and losers, and we think that in an environment where earnings growth comes under pressure, you want to be careful, you want to be focusing on that, and the lead indicator for this tends to be companies where the consensus is revising upward their projections of earnings. So we favor companies where the earnings are being revised up versus those where they're being revised down. Now, in my closing moments here, I just want to touch on our views on India. And I think I want to start here with the idea or the fact that we've had record foreign selling in India of about $20 billion really since late last year. And actually on a dollar basis, this is the greatest net foreign selling that we've had in the history of the market, slightly above the roughly 16 billion we had during the global financial crisis. As a percentage of the market capitalization, it's 0.6%, whereas in the GFC, it was 0.8. So depending which metric you look at, it's either the most significant or the second most significant foreign selling. But the point is we've seen a lot of outflow. But as I'm sure everyone is aware, that has been more than compensated by record net domestic buying, particularly if you look at the right side chart here, the flows into domestic mutual funds have been very, very significant, consistent, and high and stable. So the left side chart here, if you look at the blue line, the dark blue line versus the lighter blue line, it's really kind of a battle, a tug of war between the foreign sort of disinvestment in India versus the domestic enthusiasm for equities. And we think this is a very interesting kind of struggle that we want to monitor. The net of it, as you can see from the sort of the pink line here, is we've been in a bit of this, what you might again call this kind of fat and flat trading range. And I think this is really the result of this kind of battle of the titans, you might sort of say, between the foreigners and the domestics. Now, the reason principally why we've taken a somewhat more balanced or measured view on India really is just valuation. I mean, the punchline for our view is that we love the story, but we don't like the price as much. And you can see here on the left side that the forward 12-month PE for India, it peaked at about 24 times late last year. It's lowered a bit, but it's still close to 22 times, which in terms of, if you look back over a 20-year history, is really at the upper end of the range. And on the right side chart, we look at the valuation of India relative to all the rest of the region. And here, too, we're at record highs. We peaked at 65% recently, came off a little bit. It's re-expanded about 64% when we did this chart a few days ago. So we're just saying that India probably needs to kind of digest the handsome gains that it's enjoyed and let the underlying earnings catch up so the valuations will compress, and then we can have another good leg up. Now, just turning quickly to our macro forecasts, we have taken our numbers down a bit. We're still a bit above consensus, frankly, for this calendar year, but we are mindful of the current account balance, really because of the oil price increases that I was mentioning. And if we look at the impact of oil on India on the right side of this chart, we see India is one of the most potentially negatively impacted by a large oil price shock, which for argument's sake, we've calibrated here at $30 per barrel. So we just want to be mindful of these challenges that the market's facing. Now, turning to earnings growth on the left side over here, we're somewhat below consensus at about 19% EPS growth this year compared to 23% for consensus. We're in line with the 16% growth that's forecasted for next year. And if you look over at the right side, this is a waterfall chart that shows that banks, energy, and tech are really the key drivers of the expected growth that we're looking for. So really, I mean, the fundamentals are still great in terms of earnings growth. Overall for the region, we're looking at just 6% EPS growth overall. So India stands out. It's just the pricing that we're not as enthusiastic about. So to close here, we just want to show what our preferences are within the market. We like the banks, of course, energy, which is a beneficiary of the higher oil prices, industrials, and some of the domestic consumption and construction plays, cement and so forth. And we're less keen on the NBFCs, some of the staples, and other parts of the market that don't have as strong earnings growth. So with that, I think we're pretty much at time. I'd welcome our conversation. Let me stop my prepared comments there and hand it back.
Thank you for that lovely presentation. Fantastic to talk to you. I distinctly remember a conversation we had on the voyage, different forum. It was in Mumbai, and we had the pleasure of hosting you to lovely Indian food.
And that's the downside of the virtual aspect. I don't get a good meal out of this.
Tim, now you made very interesting points about how should one go about approaching asset allocation in an inflationary environment. The attendees here are distributors, they're investors, and they are also advisors to clients. And the question which perhaps everybody wants to understand from your standpoint is that what is the best way to make your portfolio or your wealth Teflon coated, if I may use the word, against inflation?
I mean, it is a great question, and it's obviously a difficult one. I mean, I think there's, we live in such an uncertain and capricious world that I wouldn't want to say that you can sort of, bulletproof the portfolio. But what I think we can say is that in a world where inflation is rising, the relative attraction and performance of real assets that are more linked to the real economy, tend to do better than some purely financial ones. And so in practical terms, that would suggest and reinforces our view on being overweight commodities. We still think that the market's underpricing energy stocks, for example, and some of the metals and mining stocks. We think that gold has a place in the portfolio. Gold is a strong place in the Indian heart, so that will, I'm sure, resonate well. Real property and other sort of real assets should be favored. So if you can kind of diversify your portfolio along those asset class lines, and then within equities, favor the parts that I was quickly summarizing. And I know I spoke fast because I had to get a ton of stuff out. So forgive me if I went a little bit too fast a clip. But there are definitely parts of the market that look better. The other point which I'll make, and we just had a conference call with my other global colleagues just before our conversation now, that we were making, in one of the themes that we like within the market would be high dividend paying stocks. Because what we've noted is that if you go back to the 1970s, that stocks that pay high dividends, which give you kind of an immediate source of cash flow, were a very good place to be. So I think if you combine, that margin resilience, the high dividend paying theme, the compounding growth theme, and then the real sort of asset theme, that would at least guide you in the direction of having a more insulated portfolio from the macro challenges and the headwinds that are buffeting markets now.
Tim, you understand the importance of risk and the starting point of valuations more than anyone else. So while the India story is a promising one, if the starting point is today, which is 8th of April, for next 3 years, do you think one should expect low returns, no returns, or high returns?
So, I mean, it's a great question. Thanks for asking it. And I'm gonna give you a kind of a two-pronged answer. And I'm not trying to be a two-handed economist here, but I think there really are two important points to bring out. So number one is that if you look through financial history, and there's tons of textbooks and learned studies and all this, one of the most significant determinants of future return is the price you pay at the start of your investing period. So it's not surprising if you pay a high price, it's harder to have a higher return over time. And if you start with a lower price, you generally have a much better. Sorry, I had an alarm here. I just want to turn it off. You generally had a much better potential for return. So just purely from that, it would say if your starting point for India is paying over 20 times earnings, then you shouldn't expect as strong returns as perhaps we've enjoyed over previous, call it 5-year investing intervals. However, this is a really strong caveat to that. India looks like it will be able to deliver quite strong earnings growth because of the very favorable underlying fundamental dynamics. And on top of that, and we've written a detailed paper on this late last year, we are very excited about the theme of what you might call the increasing digitalization of the Indian equity market. There are over 60 unicorns in the private sector that have been formed, and those will be coming into the market through listing. And as they come in, the configuration of the Indian index will start to shift, and will take on more of this kind of digital economy structural growth component. And that's something which, for example, in China was a terrific 10-year investment theme. A lot of wealth was created. We think of a similar dynamic that's taking place in India. And then just the last item I'd like to mention is that the outlook for a lot of other parts of the region, and here, there's a lot of concern about China, isn't looking quite as good as it was before. So I think that India, that high relative valuation we spoke about, I think it is high, but I don't think it's going to come down to perhaps where it has been, over the past 10 years. I think it stays high. So if you roll all this together, I think, yes, returns will be somewhat lower than we've enjoyed, but I still think they're going to be good in absolute terms. And India will be a good place to be investing. So the bottom line is that if investors can either see some sort of a price correction in India, which would give a better entry point, or we can wait for some time to let the earnings catch up and let the multiple just naturally compress, then I think that will be a very good time to re-engage in a more active manner in a positive Indian investment thesis.
So, Tim, irrespective of the timeline we are talking about in the history, markets, they follow a cycle. It starts with skepticism, then there is participation, then there is euphoria, bubble, and a bust. At what stage do you think Indian markets currently are in?
Great question. We have a similar way of kind of characterizing the investment cycle. I'd say right now we're in what we call the growth phase. So we have a lexicon which is despair, which is the bear market, and then we call hope, which is when the market rallies before the fundamentals change, and that's when you get PE multiple expansion. And then you get the growth phase, which is typically when multiples compress, but the underlying earnings growth comes through. And then you get your sort of euphoria blow off stage, and then the whole cycle tends to repeat. I think right now we're in a period where it's really the growth phase where valuations have expanded, and now it's going to be the earnings growth which catches up. We'll probably see some forward valuation compression, but as long as the growth comes through, I think we're going to be in that longer growth phase for India.
Tim, I distinctly recall a conversation on some other forum a couple of years ago, and this was once upon a time, literally, in life of a strategist. You made a call that you see a lot of domestic money coming into India. It was an outlier comment a couple of years ago, but look at the reality. It is now part of an Indian saver's life that you're investing into equities. Could that be the differentiating factor, Tim, which will keep Indian markets always at a premium? Because demand now from the domestic folks is much higher than the supply coming from the global folks.
Well, it's a terrifically well-asked question, and thank you so much for remembering what we said. It's good you remember the good things we said, not the bad things you said.
You say good things about India, so I like to remember them.
Yeah, okay. But in all seriousness, this is a very important point, and it's something which is, I think, particularly critical to all your distributors, who are the attendees at this conference, because I think this really is sort of their lifeblood, so to speak. And really the point here, the concept is the term we've dubbed, so to speak, is what we call the financialization of Indian household savings. So the concept is that Indian households save a lot. They've got a very strong and robust balance sheet, but the majority of it is in property, it's in cash, it's in gold, either around mother-in-law's neck or in the drawer, but not that much of it is in financial assets. And our view, based upon looking at how various other economies have developed over time, is that there's going to be a development of financial market investment, and there will be a structural shift and embracing of financial market investment by the Indian household. And so we think there's a long way to go in this, because if you look at the current deployment, we're still well below 10% of the household balance sheet being invested either directly in the equity market or through mutual funds or other similar intermediaries. So there's a very clear long-term structural trend of increasing share of financial assets in the household balance sheet, which itself is going to continue to grow as India's economic growth increases and people's wealth rises. So we think this is a really strong, fat, long-term trend, which is quite positive, and I think underpins, as you asked, kind of that sort of higher valuation for the Indian equity market. But if at the risk of becoming perhaps overly enthusiastic, I think the other kind of additional factor which we can look forward to, which could be a turbocharging factor on top of that domestic demand for equities, is the return of the foreign investor. I mean, for example, I'm in New York right now. I've just been going around seeing investors in Boston, New York, Connecticut, and so on. So I've just had 30 conversations with U.S. investors, and the general take in India is yeah, we like it, but we had been overweight, looks a bit expensive, we pulled back, but we're looking to re-engage at some point. So I think that $20 billion of net foreign selling gives foreign investors the opportunity, if you would, to reload later on if they again become more enthusiastic. So I think that the combination of that secular structural deployment of Indian household balance sheet into the equity market could be complemented by a return of the foreign investor, and that could actually give us some pretty handsome returns for Indian equities at some point down the line. And I think that's an important thing to keep in people's minds.
Thank you for that. So Tim, I'd like to draw your attention to perhaps the most important financial headline last week, which is that the US bond yields have inverted. And historically, when that has happened, that has led to recession. How should Indian investors react to this headline? Because recession is bad news for everyone.
This is true. So there's a few points that are important that we need to unpack, because you said this is super top of mind. Just to deal with the recession question, first. I mean, of course, if the U.S. goes into recession, that's not good, for anyone. I think in relative terms, India will stand out as one of the more attractive places fundamentally, because India is still enjoying sort of the tailwind of recovery from the COVID-induced setback. And so, if trend growth is here, kind of COVID drove India's growth below that. We started to recover. We're still trying to getting back to, where we could be growing at, and that's indeed why we think the economy could grow somewhat over 8% this year. So I mean, there's obviously good potential trend growth, but then on top of that, you get a bit of catch up, which we still have to enjoy. And so I think India and other parts of Asia indeed stand out in happy contrast to the risk in the U.S. of actually tipping back into recession, because you got just a completely different kind of monetary and fiscal policy cycle, as well as kind of growth dynamic, which underpins our preference for sort of parts of the world, including India, away from the U.S. But that being said, if the U.S. tips into recession, typically the equity market, would sell off to some degree. And we've noted that in the last 30 years, every time the U.S. has gone down 10% or more, Asia will follow. It may follow to a lesser degree, but it's going to be a depressing effect. So I think that is true, and it is something that domestic investors in India need to keep in mind. But there's a subtlety here. Forgive me if I'm getting a little bit sort of into the weeds on this, but the inversion that you spoke of is happening in what is colloquially called as the 2-10 spread, the difference between the 2-year yield and the 10-year yield. And the reason why I mention this is that we need to be careful about what signal we are extracting from that inversion of the yield curve. And the reason I mention this is that it's happened because the 10 years yield hasn't risen as much as the 2-year, which is why the curve is flattened and slightly inverted. The reason why 10 years aren't higher than you would think they should be from a fundamental perspective, given where inflation is in the US and so forth, is that from a global cross-sectional perspective, US yields look pretty darn attractive, because German bonds are yielding currently 60 basis point, Japanese JGBs are yielding 25 basis points, and the Bank of Japan just came out and said they want to keep those there for what's called yield curve control. So my point here is that for the global pool of fixed income capital, which is quite large in the trillions of dollars, even if the U.S. looks overvalued, relative to what you get elsewhere, it looks great. So what that's doing is it's suppressing kind of artificially, for demand supply reasons, the 10-year. So what I'm getting with this is that the signal is kind of distorted by this technical kind of flow of funds issue, and may not be giving us as clear an indication of actual economic recession risk as it typically does in other circumstances. So that's why that's the point I wanted to make. And again, as I said, we've got various models that sort of look at the circumstances economically, and the punchline is that we think there's about a 30-35% chance of recession, but it's not higher than that currently.
Tim, we just have 5 minutes left. I know you've got a long day ahead, and it's been a busy morning for you. So my last but one question, Tim, is that if I look at financial history, there are decades when a region in the markets does well, whether it was Japan in 80s, followed by US markets, China, last 10 years dominated by US blue chip stocks. What are the chances that next couple of years could be a linear growth market? India could be a linear growth market like we saw in US in last 10 years?
You say linear in terms of like that sort of India in particular could be kind of more on a secular uptrend compared to other markets? Is that your question? So
could get one bad year, but a couple of good years.
Yeah, I mean, I actually have a lot of sympathy for that view, and this gets back to the kind of the longer term comments I was making before about this change within the Indian stock market and economy, this greater embracing of the digital economy. And forgive me if I'm telling people here something that they already know and living and breathing, but we think there's actually a lot of positive potential in terms of what you might call the digital common good, which has been put out. And this, of course, is the India stack of the Aadhaar, biometric identification, the banking, the capability of doing digital banking, the KYC capabilities digitally, and then of course the universal payment interface, which allows for cashless transactions. The combination of this is the analogy here is with the construction of the U.S. highway system in the 1950s, which was something that had tremendous ripple effects. It was sort of a common social good that was put in place, but that connecting the U.S. by that highway system engendered a huge growth, productivity spurt, and a growth spurt. And I think the analogy here is you've got a digital highway which has been put in place, which is a common good, and is enabling the rapid formation of companies on top of that. And it's also including the vast majority of the Indian population, which previously was in the informal or the gray economy. And the potential here is that for however strong India's growth could be, that digital good and investment which has been made could actually boost up India's growth rate, even further. We don't know what that is. Could it be 1 percentage point or, more or less? But it certainly is a positive. And as that starts to be explored more significantly, that could lead to a structurally higher growth and better earnings and so forth. And that could give us a much better longer term Indian investment story. So, we're on board with that longer term picture. It's just right now at the current entry price, getting back to your previous question, we're a little bit less enthusiastic. So, really we're sort of buyers on a pullback. The longer term structural story should be positive. And that's how we kind of square the circle on that.
So Tim, last question, and something which in a sense I applied and I learned in the COVID times, tough times for all of us. Lenin once said that there are decades where nothing changes, and sometimes there are years when a decade changes. How would you like to apply that in context of investing? What has changed for long-term investors because of COVID?
Obviously a lot. I think this gets into a larger conversation we have time for, but just very briefly, it shows, first of all, just how, sudden shocks can happen. So we'll need to be a bit humble in terms of what we think and what we expect can happen. And it suggests that, things like diversification, margin of safety and all that sort of stuff are really important because you never know where the next shock comes from, including just most recently, topically, Russia's invasion of Ukraine, right? And the oil price shock we're having. So that'd be one point. The second thing that both COVID as well as this most recent geopolitical conflict shows is the threat to supply chains and how the sort of the extension of the supply chain globally and the focus on reducing costs. That's now shifting somewhat to recognizing we need some margin of safety in the supply chain. It's probably going to shorten things. You've got sort of a different sort of geopolitical configuration, and it may result in a less efficient world and one where you can have some duplication of supply chains and costs. And that's something we need to weave into the conversation. So I think that those would at least be a couple of takeaways that we need to be mindful of. And I think it goes back to your original question, which is a great way to sort of, close this conversation, which is, how do you weatherproof, bulletproof Teflon coat, your portfolio? I think that's a really well asked and important question and an important one for everyone on this call to be considering actively as they advise their clients.
So Tim, we started with that, how we would love to host you to a lovely meal, Indian food, paneer tikka and naan, perhaps your favorite all time, and little dal makhani and tadka dal. So we look forward to have you soon in India, and it was lovely to meet you again.
Well, thank you so much, and I'm going to take you up on a rain check on that meal for sure. So thank you so much for the opportunity.
Sumit, I'll hand it back to you.
Well, that was a very insightful session by Mr. Mo, and thank you, Nikunj, for moderating that. Also, thank you, Mr. Mo, for that presentation and giving us those great key points for thought, and a lot of food for thought. I know we were talking about food, so a lot of food for thought as well. Before we move on to our next session, here's a quick poll. This is the last poll for the day, and I think it's perfectly placed because it's just after Mr. Mo's presentation. So here's, in fact, actually, sorry, before we get into the poll, the speaker rating session will have come up. So please do rate the speakers. We are getting a lot of your tweets, a lot of your comments on where you've used the hashtag Voyage2022 and tagged us at the rate ABSLMF. And these will be used in a short while when we will declare the winners both from yesterday and from today for the Smart Twitterati contest, also for the Active Voyager of the day, rather 2 days, yesterday and today. So we'll be announcing that very shortly. If you're done with the feedback on the ratings, here's your poll. This is the final poll. Here's the question. Do you expect India's position to strengthen on the global stage post the current geopolitical crisis? Answer is simple: yes, no, or you can't say. So it's quite pertinent. We are all keeping a tab on the news. We've heard from Mr. Mo and Nikunj also. So do you expect India's position to strengthen on the global stage post the current geopolitical crisis? Yes, no, can't say. And after this next session, after our final session, I will be putting forth the results from this poll. I'm curious to know what everyone is thinking. All right, now time for our final session at Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now. Now, over the course of the 2 days, we've heard from experts on both the equity outlook as well as the view on debt and fixed income. We've heard them speak on domestic growth and a global outlook. But as an investor, it's important to get the right mix of all of the above. And that is where asset allocation comes into play. So our final session will have the panelists talk about the importance of diversification and asset allocation so that one can get the right mix. The discussion will be moderated by ET Now's Aisha Faridi, and she'll be in conversation with Vinod Bhatt, Portfolio Manager, Mohit Sharma, Fund Manager, and Harshal Suvarnkar, Fund Manager at Aditya Birla Sun Life AMC Limited. So let's get ready for the next session, which is just coming up.
Hi, good evening. Like my colleague Sumit Lakhutia just announced, we're here to talk about this evening our last panel at Voyage, asset allocation strategies for optimizing gains. And I have with me Vinod Bhatt, Mohit Sharma, as well as Harshal Suvarnakar. Gentlemen, great to have you all. Good evening. Thanks for tuning in. Harshal, if I could start with you, I'm taking a lead from all that food chat that Timothy Moore and Nikunj was indulging in. Much like that your thali needs to have naan, paneer tikka and whatnot. Similarly, our portfolios also need to be as diverse. So I want you to first begin by talking about why asset allocation and diversification is a must for your portfolio, not just for every meal as well.
So from a asset, so if you are investing, across assets, it's important that you diversify your portfolios because, as you say, if you put all eggs in one basket, you would want to diversify your risk. So you would want to look to have a core portfolio, a satellite portfolio, and a strategic portfolio. Basically, to keep your liquidity needs. You also would want to build a core portfolio and as well as a satellite portfolio to enhance the returns on your investment as well as diversify in case of any asset class underperforming the market.
Sure.
For that, we also have our asset allocator fund, which can allocate assets basis the markets and basis the logic that we would have created at our end.
Sure. Harshal, now, central banks are looking at normalizing policies across the globe, and the RBI is going to soon start, maybe tomorrow itself. How is it that one should look at investing in fixed income markets at this juncture and in light of all the developments which are currently taking place?
Sure. So, financial markets are pretty much efficient and, they tend to price things pretty much in advance. So, whilst, globally central banks have started the process of normalization, this time you're seeing that the developed markets and central banks are going and are expected to go more aggressive than what EMs are. But, over the last 1 year, we've already seen a lot of rate increases. So let's say, in India, you had your 10-year at 6.10, and it's already, we are at about 6.90 right now. So, and if you look at, how the curve or how yields are placed across the tenor, your overnight rate is at 3.40, which is near the reverse repo rate, and your repo rate is at 4, whereas your 1-year bonds are trading at 5%, whereas you would have your 5-year bond trading at around 6 or 4-year bond trading at around 6.10. So effectively what we are trying to say is that, markets are already pricing in these normalization of rates. So whilst rates will normalize, there will be intermittent volatility. Basis the 1-year point that you see, we are already pricing in 4 to 5 rate hikes, which might come from RBI. So the curves are steep. It kind of provides an insurance to investors against the rate hikes, which will happen in the future. So effectively what investors should do right now, especially for, when they are looking at investing, is match the horizon of their investments with the underlying funds that they would be investing in, so as to take benefit of the insurance premium or the pricing of rate hikes, which we spoke of from RBI, and so that they don't end up having a negative carry or a drag of cash because the curves are steep. So let's say if you had a 1 year duration, you can earn a 5% return basis the bond that is trading right now, versus if you were to deploy in your overnight markets, you will end up earning 150, 160 basis point lower, which would be at about 340.
Sure. Right. Mohit, if I could, come to you and pick up one instrument here, that's index debt funds. Now, one has seen that there has been a lot of flows into this instrument. For all the viewers who are joining in right now, and for all those who are seeking advice in this, tell us, how do index debt funds work, and what exactly are they, and why is it that one should even look at them as an investment instrument?
So 2-3 questions. So let's start with what an index fund is. So an index fund is a fund which actually tracks a predetermined benchmark index. Now, a benchmark index could be set by taking into account different factors. It could be a particular maturity or duration, let's say a 5-year or 10-year point. It could be the rating profile, a sovereign or a AAA or a AA. It could be a particular segment of the industry, let's say only government bonds or NBFCs or banks and so on. So the benchmark index is made by a combination of one or many of these factors, right? For example, let's say we have a 4-year SDL index, right? So now the fund manager's endeavor would be to buy securities which imitate the return or track the return of that index, which is to buy something like a 4-year SDL if it's a 4-year SDL index. So that is what an index fund is. So broadly, it is a passively managed fund which actually tracks a predetermined index. So that is what an index fund is. Now, what is the advantage of an index fund? So first advantage is that it is very easy to understand. So for example, if you have a 10-year GSEC index fund, then you know that it is going to track the return of a 10-year GSEC. If you take an example from equity side, if you have a Nifty 50 index fund, then it is going to track the return of Nifty 50. So it's very easy to understand. Second advantage is it is a very low cost vehicle, and at a very low cost point, you get a very well diversified portfolio to invest. Third point is, which is particularly true in Indian fixed income context, is that the kind of portfolio, which are being offered by Aditya Birla and even our counterparts in the industry are all very high quality portfolios. GSEC, SDL and AAAs in various proportions and nothing beyond that. So very high quality, portfolios being offered. So to sum it up, it's a combination of very high quality portfolio, well diversified, very easy to understand at a low cost point, and a very small ticket size. So this is the advantage of an index fund. And coming on to the point of, it is doing very well. So I would like to say that it is just starting. The initial inertia every product faces, like we have seen globally also, ETF industry took 30 years to reach 1 trillion mark. And in next 20 years, it is 20 times. It is 20 trillion now. So we are just in the initial phase, and now we are going to, most probably grow very fast from here. Because it's a very good product and makes sense for everyone.
Sure. Just talking about few of the products, what are the advantages of, say, a fund of funds, and what is so different about Aditya Birla Sun Life Asset Allocator Fund of Fund?
Yeah, Isha, I'd like to start off from your first question.
Sure.
So why asset allocation is important, because that leads into the importance of fund of funds. Like if you see the past, even the past 5 years, it's been very difficult to predict which asset class would do well. Like, every year, either it has been domestic equity 1 year, next year it has been fixed income, third year international equity, fourth year it has been gold and so on, right? So from an investor's portfolio point of view, it's very important to have at least these 4 asset classes, and in addition to real estate, in the portfolio. Because these asset classes are negatively correlated, they have different cycles. So if one asset class doesn't do well, then some other asset class does well. And that's how you get a stable risk-adjusted return. So that's the starting point, right? And that's where fund of funds come in, because as a product, for example, the Aditya Birla Sun Life Asset Allocator Fund of Fund provides exposure to 4 asset classes: domestic equity, international equity, fixed income, and gold. Right? And as I explained, in any environment, especially if you see the past 2 years, the markets have been very volatile. And as Tim also mentioned, even the next 1 or 2 years are expected to be very volatile. So in these kinds of conditions, the fund of fund can ensure that the overall portfolio volatility will be lower, and hence you can get better risk-adjusted returns. The second aspect to understand is that instead of investors trying to monitor markets, time the markets, and get in and out of funds, stocks, or asset classes, they can just invest in this one fund of fund, and they get exposure to the underlying asset classes and the funds. And the fund of fund portfolio is aligned to our fund house strategy, our outlook. We make the necessary changes in the asset allocation and the underlying funds. And the investors don't need to do any of that. And the third is all the advantages they get. So one is, if they make the underlying changes in the portfolio, they need to pay short-term or long-term capital gains tax. But if those changes happen in the fund of fund, investors don't need to pay any tax as long as they don't redeem the fund units. A dedicated portfolio manager manages this fund of fund. Overall volatility is lower, and the overall cost also is lower. So that's how I think, especially looking at how markets have trended over the past 2 years and what we can expect over the next 2 years, a fund of funds would be an ideal product for investors to look at.
Yeah, that's quite interesting, considering how balanced the approach is. You get an exposure via one fund to various asset classes, and of course the headache is the fund managers to try and figure out which one to increase allocation to. But Mohit, we were talking about index debt funds earlier. Wanted to understand how are the returns and characteristics compared to, say, traditional debt instruments?
So the returns in our index fund are well understood by the investors. I mean, like I mentioned earlier, I mean, it actually tracks a particular point in whatever we select as the benchmark index. So any guy who's sitting outside can very well find out that what the return on that particular point is, let's say 10-year GSEC, and he can figure out what his return would be. Just to take an equity example, because everyone understands equity, if a fund is tracking Nifty 50, if it goes up by 10%, your fund should return somewhere close to that number. Similar thing would happen in a 10-year GSEC or any other index that it tracks. So that is one thing wherein if it is an actively managed debt portfolio, then the fund manager would change the duration or some kind of a composition in terms of the credit part of it, and the YTM will change. So it will be slightly difficult to understand for a retail investor to understand what the return would be. But in the index, it is very easily understood just by looking at what the index is doing. So that is the return part of it. The other thing is that because in index, what happens is you are just tracking index fund, you're tracking a benchmark. So the entire endeavor of the fund manager is to just buy securities which kind of meets that mandate. So that resources are saved, like unlike an actively managed fund, you don't have to deploy a lot of resources there. Hence the low cost of it.
Sure. But Mohit, which fixed schemes you think would be suitable right now in the current global and domestic environment for investors?
Yeah, so if you want to come for index funds, we typically advise you have to come for 3-year plus kind of a period, because all our index funds are located in a 4-year bucket, 5-year bucket, and very soon we'll be launching the higher duration buckets also. So we advise index funds for 3-year plus kind of investment horizon. But if your investment horizon is slightly on the lower side, let's say for 3 to 6 months, because of the global uncertainty and also the uncertainty regarding what stance RBI may take going forward, given a lot of things have changed in the last policy, the geopolitical impact and the corresponding impact on the commodity prices and global rates. So taking that into account, again, like Harshil mentioned, the curves are very steep. And based on our investment horizon, you should pick a particular point. So if for example, if your investment horizon is, let's say, 3 to 6 months, then you should come for a low duration fund or a floater fund, which currently are running up duration of 0.5 to 0.6 years. And they provide extra yield of around 125 basis points over a liquid fund, which broadly translates into around 18 to 20 basis points per month of roll down, which is a very good, investable opportunity for somebody who's looking for a very short term kind of investment, 3 to 6 months. For somebody who's looking to invest in, let's say, a 1 year kind of horizon, we are suggesting short term fund category, where again, it is a duration of around 0.7 to 0.8 years higher than the low duration category, and about 80 to 85 basis points of extra carry, which effectively translates into around 10 basis points per month of roll down over and above what we are getting on the low duration part. So 3 to 6 months low duration floater long, 1 year 1 year to 2 year is the short term funds, and 3 year and above is our 4-5 year index products. So that is what we would suggest.
Sure. Harshil, I guess a lot will depend on what the central bank chooses to do tomorrow. What are you expecting from the policy? Given that the Fed has already moved, do you think the Reserve Bank of India as well, the governor is going to, or rather the MPC is going to bite the bullet?
Yeah, so actually, tomorrow's policy is very important for the fixed income markets, and maybe, it also guides the equity markets in terms of what the RBI is thinking. So it will help all of us gauge RBI's reaction function to a lot of changes in the macro environment that has happened in the last quarter. So let's say the last policy was in February. From February to April, we have seen 3 to 4 key changes that have happened in the market. One is oil prices. Oil prices at the time of last policy, crude was at about $80. Now it's hovering slightly above $100, which is about higher by 25-30%. And commodities which have been exported by Russia, Ukraine because of the crisis, you're seeing that all of these commodities have spiked up, and these can cause inflation to spiral. And we've already seen some of the price rises which have been passed to the consumers by way of petrol, diesel, or the retail price increases in energy over here also and across the globe. Secondly, of course, because you have a lot of fertilizers which are being exported by Russia and some by Ukraine, and some commodities like sunflower oil, etc., which used to get exported from there. So global food prices also have risen. But, because India is primarily export oriented on the food side, you've not seen such a large impact. But, that gives a threat to us, because, you can have indirect impact on our food prices because of fertilizer price increases. Third, on growth, we've seen that, Omicron wave is behind us. COVID and other high frequency indicators for growth are indicating a robust growth progress in India. But of course, a key difference that, RBI keeps pointing out is that, for India, if you were to draw a trend line, like we are seeing about, how Tim spoke in the last session, we are still below the trend line of growth in India. Whereas, if you look at DMs, especially US, you are seeing that, their growth is above the trend line. So of course, growth looks good, but, we're still below the trend line. So we have to see as to how much RBI increases their inflation forecast. And, apart from this revision in inflation forecast, we have to see what is the degree of change in RBI's commentary. Whilst, RBI might move on rates, but what is important is to what is the degree of hawkishness that RBI shows towards these changes which have happened, and what they are thinking about normalizing rates, which will drive all markets. And especially on the last piece that, the government has announced about 59% of its overall this year's borrowing in the first half, which is a very heavy number. And as per our calculations also, there is a demand supply mismatch, because of the large borrowing program. So we will need RBI support in some form. So we have to see if what RBI does for the support of the government borrowing, or else we can see, especially belly of the curve, which you say about the 7-10 year space, can increase, if RBI doesn't provide support over there. So these are the key considerations and things to look out for in tomorrow's policy and the expectation that market will have.
Sure. And I guess that's when Vinod is going to juggle around the fund of funds and maneuver allocations accordingly. But Vinod, if I were to, put the spotlight on you, just wanted to understand, given how, March 2020 began with, when you saw, not just Indian investors, but The world rushed to safe haven assets such as gold. Then came the mighty equity rise, and we've seen that bull market, a raging one at that, besides a few volatile bouts here and there, play out for the last 2 years now. How has Aditya Birla Sun Life Asset Allocator delivered performance so far, and how is it that it's managed to be so consistent?
Right. Yeah, that's a good question. So if you look at the performance, the last 1 year return has been 15%. The last 3 year CAGR return has been 15%. Last 5 year CAGR return also has been around 12-13%. And we have been consistently in the first or second quartile for the short, medium, and long time frames. And the main reason for this is the streamlined process that we have set up internally, and which has really helped us over the past 2-3 years when we have seen so much market volatility. So the way we work is, every week, every Monday morning, we have our fund manager meetings where I get inputs from all the fund managers in what they are thinking about the market, how their funds are positioned, and so on. Right. So that gives me some information to stay ahead of the curve in terms of maneuvering the portfolio. And every fortnight, we have our analyst meeting where the analysts talk about their sectors, what can be expected from the sectoral thematic funds, and so on. So that's an additional informational advantage. And lastly, every month, we have a meeting with Mahesh Patil, who's our CIO, Kaustubh Gupta, who's our head of fixed income, and Bhupesh Pamita, who's our economist. So we discuss global macro, like, what's the Fed going to do, how it can impact markets, what's happening in China, for example, or what the RBI can do, what are the expected earnings growth rates, what returns we can expect from different asset classes. And so that keeps us on our toes, and we kind of are quite regular in monitoring the portfolio and rebalancing as required. So for example, if you go back to March 2020, just before the COVID crisis, our equity allocation in the portfolio was about 45%. And if you remember, after the crisis hit, we saw almost a 45% drop in equity markets. And we have a model that we run that looks at various valuation metrics and recommends what is the allocation for different asset classes. And that model suggested that we increase the equity allocation to 100%. And then we had our internal meetings and discussions, and we raised equity to 80%. That's kind of the upper end of the band. Right? And since then, the markets have rallied, so that helped the portfolio. And as the markets have rallied, the model suggested reducing the equity allocation. So over time, we have reduced it, and today we are at about 42%. Right? Same way, gold also, earlier we had 5%, we increased it to 15%. And as gold rallied, we have reduced it to around 10%. Right? So basically the point is that we follow a process that takes in both quantitative inputs from the model as well as qualitative inputs from our fund managers and CIOs. We regularly monitor the portfolio and do the rebalancing as required, and that is what has led to performance consistency.
Great. That's such an insightful, insight that you just gave us into how the fund of funds has actually maneuvered its moves all from pre-COVID up until now. But great to speak with all of you. Thank you so much, Vinod, Mohit, as well as Harshil. You gave us a great peek into how one should be looking at allocating strategies for optimizing gains at a time like this, given that a lot has changed from the start of COVID in the last 2 years to now. But good speaking with you guys. Sumit, with that, it's back to you in the studio.
Fantastic. Thank you so much, Aisha, for that. And thank you so much to Vinod, to Mohit, and to Harshil for that session. Before we move ahead, the ratings must have popped up. Please do give your ratings for this session. And most importantly, just before going into that final panel, I had a poll question for you, and I had asked you that do you expect India's position to strengthen on the global stage post the current geopolitical crisis? There was and the options were, obviously there were 3 of them, and I've got the answers here. Let me discuss them. Let me share them with you. In fact, whopping 83% said yes, they are expecting India's position to strengthen on the global stage post the current geopolitical crisis. 9% said no, and 8% said can't say, but a whopping 83% have said yes, that they are expecting India's geopolitical position to strengthen. So they're quite optimistic, and we're looking good for the future. Well, this is bringing us to the close of today's session. May I request you, before you sign out, wait, I'm still going to announce the winners of yesterday's contests and today's, but you have to hear me out for a couple of more minutes. Before that, there's a feedback button right at the bottom on the right side of your screen. Please do click on that and leave your feedback. We'd love to hear. Many of you left your feedback yesterday, and that's been really helpful to us. We'd love for you to leave your thoughts with us, your suggestions on how we can make this even bigger and better. I will be announcing the winners. Before that, a quick recap on what the day has been. It's been a very exciting day, day 2 of Voyage 2022. This is the 9th edition, and well, we kick-started with Mr. KV Kamath coming in. He spoke about how banks are projected to grow at 1.5 times GDP rate, and he said that as a nation, we need banks that can support a $5 to $10 trillion economy. So definitely a lot of more growth. There is a lot more space for growth in the banking system, as per Mr. Kamath. Then we moved on to a session with Bhupesh Bameta and Sunaina Dakuna. And Bhupesh spoke to us about the impact of the Ukraine crisis on the global economy. He also spoke about what has caused the recent surge in commodity prices. Quite interesting to know on that. Sunaina then spoke about the health of corporate India and weighing in on the trends in residential real estate, as well as she spoke about the recovery in the power sector. Then we had a lovely session with fund managers and senior analysts. There was Dhaval Shah, Nitesh Jain, Jonas Bhutta and Chanchal Khandelwal. Dhaval spoke about the consumer durable sector. Nitesh spoke about the infrastructure space. Jonas spoke about the industrial sector outlook. And Chanchal spoke about the real estate space. So it was a great insight on the sector specific thoughts that's going on with these fund managers and senior analysts at Aditya Birla Sun Life AMC Limited. Kind of puts us into their shoes, so we know how they're thinking, what their outlook is. Then, of course, the amazing session with Mr. Tim Moore, and I'm hoping he'll be here with us in the next Void session whenever we do that, and I'm sure it'll be on ground, and look forward to having all of you there. And I'm hoping Mr. Moore joins us again. And he spoke about his outlook on global equity market returns, about the geopolitical developments. Very insightful thoughts that he had. He said he was joining us from New York, but he was sharing his view of the developments and how he thinks that will impact the way ahead. And also, most importantly, he spoke about the India investment cycle. That was quite interesting for all of us here. And then finally, we had this very important panel on asset allocation, where Vinod Bhatt, Mohit Sharma and Harshal Suvarnkar spoke about their thoughts behind asset allocation, how they are managing the funds at Aditya Birla Sun Life Mutual Fund, so that we are being able to get, maybe more bang from our buck, right? That was quite an eventful day, I feel, and we got to hear from so many different perspectives. Now comes to the part that I'm sure many of you are waiting for. So before we wrap up, here are the winners that I would like to announce from the contest that we've been running. As you know, we have 2 contests that were going. One was the Smart Twitterati contest, the person that has tweeted the most on day 1, that was yesterday, and day 2, most relevant tweets. And the winner is Joswin Menezes. Joswin has been way ahead of the pack. Day 1, there were 355 tweets from the handle, and day 2, almost double, 694 tweets. I mean, I'm sure, Joswin, if you're listening in, throw in a couple of more tweets, man. Let's go double of 355 that you did on day 1. So congratulations, Joswin. Thank you so much for tweeting about everything that's been happening on both the days at Voyage. And also, the team will get in touch with you with the prize that we have kept aside for you. So congratulations to Joswin Menezes, both day 1 and day 2. The other contest we had was Active Voyager of the Day. where we will be announcing the winner who's been asking the most relevant questions and making the most relevant comments both on day 1 and day 2. Well, day 1 was Vimal Shah. Congratulations, Vimal. And day 2 is Pradeep Doshi. Congratulations, Pradeep Doshi. So these were the two who've been asking on day 1 and day 2 the most relevant questions and comments on the platform. So Vimal, Pradeep and Josween, the team will be reaching out to you shortly. Thank you so much. But thank you for everyone else also who tweeted, who shared photos, who shared comments, and who also been answering our polls and are leaving ratings and also the feedback. Well, that's all from our end here. But do remember that these conversations always continue. Please stay in touch. Keep messaging us. Tag ABSLMF. We look forward to hearing from you, to getting more of your insights, so that we can make this edition, this whole thought leadership conclave, this event better and better every year. Thank you so much. We look forward to seeing you at the next edition of Aditya Birla Sun Life Mutual Fund presents Voyage, partnered by ET Now. My name is Sumit Lakhotia from ET Now. Thank you so much. Goodbye. Have a great day ahead.